We are going to hit record. Good morning. I'm going to so where we left off last time is hopefully we were getting ourselves ready for what we are doing today. And this is the information I gave you guys where you can reference, where you can find the stuff that we're talking about today. Now we're getting ready to get back in the book for a second, and then we'll go off PowerPoint. But all these page numbers you see here are the various places in the book that discuss the math that we're getting ready to do. The math that we're getting ready to do is something I refer to it as a mini closing disclosure. And the reason I refer to it as a mini closing disclosure is because we're not doing a full-blown closing disclosure. We're not doing a full-blown settlement statement. You won't have to do that until you come to post-licensing. So you guys have that to look forward to. What we are focusing on in this class, in pre-licensing, is bottom line, we want to know how much does the buyer have to bring to closing. So we're just focusing on the buyer. And we're going to look at all the buyer's debits and credits. And based on how much they owe and how much money they have coming in, we're going to determine how much money they have to bring to closing. When buyers come to closing, they come with readily available funds. Readily available funds, cashier's check, wire transfer. They're not going to be able to bring a personal check. So our job as their agent is to look over the settlement statement, make sure we agree with the numbers, make sure we don't have anything conflicting information. And once we determine that we're satisfied with that number, then we actually call our buyers and say, go to the bank and do a wire transfer or a cashier's check. We're the ones that are ultimately responsible for making sure the money they bring in. This math, guys, I'm going to be really honest with you. This math that we're getting ready to do is a whole lot of work for one test question. 1 point, one test question. It's a whole bunch of work. It's of my opinion that this is probably the most important math that we do in this class, because this is old car. This is what we owe our clients. Who wants to remind me? Let's remind me in a chat. Let's warm up with the chat. Remind me in a chat. What's the A in old car? If we're old carring, what's the A in old car? I see you guys coming in. Good morning if you're just joining us. The A in old car is accounting. And accounting means we have a duty to make sure that our clients, not only that our clients' money is protected at some point, if we have their money in our hand or in the transaction, but also to make sure that their final numbers are accurate. Because this math will take you the longest of everything on your test, this is the math that'll take you the longest. I always want you guys to save this math for last. When you come to this problem, bookmark it and move on. And the very last thing you do on your test is going to be this settlement statement, this closing disclosure, because this is the one that's going to take you the longest and it's only 1 point. So I don't want you to run out of time and miss everything else. Does this make sense? And because you spent so much time on this one. I'm also here to tell you guys that the more of these you do for practice, the quicker you're going to get through it on your test. Like I said, the first one's pretty painful. The second one, not so bad. The third one. So the more you do, the easier they get and the better prepared for your exam you're going to be. I also know some of you, I have taught live in person, face-to-face before. And I know some of you used to go out on break and say, this is a lot of work. I'm not going to do it. I'm not going to learn it until I get my license. And if that's the mentality that you have, then, I mean, I can't stop you. We're all adults here. But again, I say this is the most important math that we do in our real estate careers when you're working with buyers and sellers. So why not start today? Why not start now? So if you're telling yourself you're not going to worry about it till you get your license, my BIC can teach me. First off, when your BIC looks at you and says, didn't you learn how to do this in pre-licensing? Do not look at them and say, no, I did not, because that's not true, right? We all know it is. How many of you guys got to spend time on pages, well, particularly page 562? 562, good number of you, good, good, good. 562 is kind of the breakdown. It tells us things that are debits to the seller, debits to the buyer, credits to the buyer. And then over on 561, we talked about sales price being a double entry and due diligence being a double entry. And then in just a bit, we're going to get into proration. So again, you guys, the key to these for your exams, for your tests, the key to these is knowing what's a debit to whom and what's a credit to whom. So I encourage you guys to get that nailed down, because that'll make these go by a lot faster. Do I have any questions or comments before we get started? Good morning. As a quick reminder, I know we've had a week off. So just as a quick reminder, we're all committed. We all have done away with background noises. We turned the TV off. We have our other programs shut down. We've asked our family to leave us alone, no distractions. Again, you guys, these next couple of weeks are going to go fast. So I need you to be with me. Not just here physically in front of your camera, but like here. Fair enough? All right. So first thing we need to do is define a few things. And first off, let's define what we're dealing with when we do these settlement statements. And what we're dealing with is debits and credits. This is the good news. If it's not a debit, then it's a credit. If it's not a credit, then it's a debit. Debit is money going out. If you owe money, it's a debit. If the buyer owes money, if the seller owes money, it's a debit. Credit is money coming in. Think about when you leave class this afternoon and you go to the grocery store and you whip out your credit card and you swipe it in the machine. How does that show up on your statement? It shows up as a debit, right? It's money coming out of your account. It's money being spent. What about this afternoon? You walk out to your mailbox and you have a bonus check from work. You run inside and you deposit that into your account, and that money is a credit. It's money coming in. So debit is just money going out. Credit is just money coming in. When we're doing these settlement statements, good morning. When we're doing these settlement statements, we're going to prorate. And so we first need to talk about what proration means. Proration is just dividing something proportionately between two parties. The whole reason to prorate is to make it fair. Let me ask you guys a question. Let's say you were going to buy my house today. And today is what? November 1st. Happy November. You are buying my house today. Is it fair for you to pay the entire year's taxes? Is it fair for me to stick you with the entire 2022 bill? Is that fair? No. Is it fair for me to pay the entire 2022 bill? I mean, I haven't owned the house all year. So how do we make it fair? We prorate. And we're going to talk first about that before we jump into our settlement statement so we have an understanding. I think the biggest thing that we prorate on our settlement statement is this year's property taxes, real property taxes. Somebody owes somebody some money. And that's the idea of proration. Either the buyer owes the seller or the seller owes the buyer. If the seller never paid last year's taxes, if the seller never paid 2021 taxes, then the seller is going to be fully responsible for that at settlement. The only thing that we're going to prorate is that shared expense. For example, this year's taxes. Does that make sense? Is everybody with me so far on that? The seller has their debits, the buyer has their debits, but these things that we prorate. And other than taxes, we may also be prorating HOA dues, if applicable. HOA dues can be monthly, they can be annually, they can be quarterly. The problem will have to tell you. The real world will have to tell you how HOA dues. Again, you're buying my house today. It's not fair for either one of us to be stuck with the entire HOA bill. May that be for the month, for the quarter, or for the year. The other thing that we typically prorate at closing is rent. If a buyer buys in North Carolina, if a buyer buys a property with an existing lease and tenant in place, then the buyer buys honoring that existing lease. They buy honoring that existing tenant. Rent is typically paid on the first of the month. So if the if the tenant pays the seller rent on the first and we close on the 15th, then we get to share that tenant that month, right? That's what we're doing. We're sharing that tenant. First half of the month, the tenant's mine. The latter half of the month, the tenant is yours. So the things that we see most commonly prorated on the settlement statement is this year's taxes, the current taxes, HOA dues and rent. When we prorate in the pre-licensing world and for your exams, we're going to use the 30-day month and a 360-day year. If you take 30 times 12, 30 days in a month, 12 months in a year, 30 times 12, you'll get 360. For your exams in pre-licensing world, you're going to have a 30-day month and a 360-day year. So, and I can see your mouths move. In pre-licensing world, how many days are in February? 30. In pre-licensing world, how many days are in October? 30. We don't get a Halloween in pre-licensing world, do we? Every single month has 30 days. Now, you will come across practice problems in your book and possibly in Learn Test Pass that tell you to use the calendar days. You need to do what the problem tells you to get the problem right. So do what the problem tells you. I'm telling you, for your exams, it's going to be a 30-day month and a 360-day year. So what if I want my annual taxes to be monthly taxes? What do we need to do to make annual taxes monthly? If I have annual taxes, I need to break it down to monthly. Yep, that's it. Divide by 12. So when you have 360 days, when you have annual taxes, if you want to make that monthly, you divide by 12. What if you want to make your annual taxes into daily taxes? Now we need to divide by 360. You guys are great. I can see your mouths moving. Some of you are just yelling at me. I love it. Does your family wonder what we're doing in here? So annual taxes can be broken down to monthly by dividing by 12. Annual HOA dues can be broken down into monthly by dividing by 12. Annual taxes can be broken down to daily by dividing by 360. So we talked about taxes back in Unit 3. And I think that was our first math actually, wasn't it? To figure out our annual property taxes. So here's just give you guys just a minute. Let me let you warm up. Give you just a minute. Take a minute, look at this problem. Tell me what you think in a private chat if you want to share your answer, but just take a minute and think about it. you about 30 more seconds and then we'll talk about it. Okay. So when you guys first saw this math problem, what's the first thing you did? What's the very first thing you did? Did you just pick up your calculator and started doing something randomly with numbers? No, good. What did you do first? Just read the dang problem. Just read it. So what's the problem say? A property is located in Davie County, subject to ad valorem tax rate of 0.80 per $100 of value. Property's assessed tax value is $172,500. Using a 360-day year, what are the daily property taxes owed to the home? So if you remember our T-bar back from Unit 3, annual property taxes go on top. I'm trying to abbreviate a little bit. Tax assessed value goes on the bottom, and then our tax rate goes on the bottom right. Where's the rate always go? Julie says the rate or percent always goes where? Always goes in the bottom right. So now that we've identified our formula, identified our T-bar, we can start filling in what we know. I generally like to start with where I want to end, because if I can identify my X first, then it can help me know what I need to get to the X, what information I need to gather. So the problem is asking me for annual or for daily property taxes, but to get to daily, I first have to solve for annual, right? Because what's my formula tell me? My formula says annual property taxes. So I first got to get there to solve for daily. I know my assessed value is $172,500. And I know my tax rate of 0.8 per 100, or yeah, per 100 is just a fancy way of saying divide. So when I say 0.80 divided by 100, I'm going to get 0.008, which is the rate I'm going to put in here. Any questions so far? The up-down line in the T-bar means what? What's our up-down line, our north-south line? It means multiply. So you take your assessed value of 172,500 times 0.008, and I get annual taxes of $1,380. I would not put that past them to give this to you as an answer choice. I wouldn't be surprised at all if this was A, B, C, or D. And it's really easy to say, oh, it's an answer choice, so this has to be the answer. Let me put C and move on. This is why I need you guys to make sure you know what the problem's saying. Once you think you have an answer, I would like you to go back and look at the problem again and ask yourself, what are they asking you for? Because they give us, we solve for annual taxes, but the problem wants daily. So 1380 pre-licensing world has 360 days in it. So how much are taxes? $3.83 a day. Every day this year, taxes are worth $3.83. Questions so far? Good recap of Unit 3. Okay. Some other words we need to understand that we may see. Something that's accrued is unpaid. If the problem tells you that this expense was accrued, that means it's not been paid prior to settlement. If something is prepaid, then it has been paid prior to settlement. When we prorate between the buyer and the seller, when we prorate, we always need to ask ourselves who owes whom. Either the buyer owes the seller or the seller owes the buyer. That's the whole idea of prorating. Things that are prepaid have already been paid by the seller, which means the buyer needs to pay the seller back. Things that are accrued or unpaid, which means the buyer will pay them later in the year, and the seller needs to pay the buyer for those now. We'll talk more about that in just a second. So accrued items are unpaid. Prepaid items are already been paid. This is important, and this is probably one of the bigger problem topics in this section. When we prorate between the buyer and the seller, we're always going to consider the seller responsible for the day of closing. So what did we just say taxes were for the day, every day this year, $3.83? Is that the number we got, $3.83? So who's going to pay that $3.83 if we go to closing today? And the answer is the seller. Who pays the day of HOA dues? The seller in North Carolina when we prorate. And I'll tell you what the problem topic is about this. This only applies when we're prorating. If the buyer has their own expenses, their own debits to the lender is going to charge the buyer for today, the day of interest. But that's not prorating. That's not between the buyer and the seller. That's between the buyer and their lender. So what do we say the things were that we typically prorate? This year's taxes, HOA dues, and rent. Everybody with me? Everything else, things that are specific charges to the seller's responsible for. Things that are specific charges to the buyer's responsible for. My slides got off, I mentioned this, but yes, the calendar year uses the actual days of the month. Y'all don't worry about writing this down. I just throw this out here. I just throw this out here so you guys know. In the real world, when you come to post licensing, you may see some practice problems. You may need to know the actual days of the month. But again, for our purposes, for your exam, we're going to use a 30-day month and a 360-day, unless you're told otherwise. Y'all, please always do what the problem tells you. Okay. So let's talk about prorating. Let's get into this now. A true proration is a debit to one party and a credit to the other for the same amount. I'm going to say that again. A true proration is a debit to one party and a credit to the other for the same amount. Let me help put a visual in your head. Put real estate aside for a second. Pretend that real estate doesn't exist, closings don't exist. Put all that aside for 1 second. If I were to give you a check, I'm just going to hand you a check. When it leaves my hand, it's a debit. Yes, it's coming out of my account. When it enters into your hand, it's a credit, right? Because it's coming into your possession. It's coming into your account. Did the amount on the check change when it changed hands? I gave you money, right? The visual, that's kind of what we're doing with prorating. Now, bring real estate back in. In the real world, buyers and sellers aren't handing each other checks at settlement. Buyers and sellers are hashing it all out on the settlement statement, including what they owe each other. Guys, please understand the whole idea of settlement is to settle everything between the buyer and the seller. We want all matters finalized today, and that includes determining, settling this year's taxes, for example. So when we prorate, anything that's accrued and unpaid prior to settlement is going to show up as a debit to the seller, a credit to the buyer, and it will be for the same amount. You guys know by now I'm a visual person. I like pictures. And when I prorate, I like to look at what I'm prorating. If I'm prorating this year's taxes, I'm looking at the annual timeline in pre-licensing world from January 1st to December 30th. And what divides this timeline is the day of settlement. So let's go to closing on May 15th. The seller owns the property the front part of the year. The buyer owns the property the latter part of the year. What divided the year was the day of closing. When you prorate, once you draw it out so you can see the visual, see what you're looking at, the very next thing I want you to ask yourself is, who owes whom? If taxes are unpaid on the day of settlement, May 15th, that means the buyer's going to be responsible for paying them later in the year. Now, yes, they have money in their escrow. The lender will pay them on their behalf, which is why I said the buyer is responsible for the taxes at the end of the year. And when they get that bill, their responsibility is going to be for the entire year. So in this case, who owes whom? In this case, the buyer's paying the entire bill. So in this case, the seller owes the buyer for the period of time that they own the property. The seller is going to pay the buyer at settlement. You're good. The buyer's going to pay the seller at settlement for the period of time, however taxes shake out from January 1st to May 15th. So you got 30 days in January, 30 days in February, 30 days in March, 30 days in April, and then 15 days in May. So we got 30, 120, and 15. So in this case, the seller would owe the buyer for 135 days. Annual taxes divide by 360. 360 times 135. It'll show up as a debit to the seller, credit to the buyer. That's all we're doing when we're prorating. Is that fair now? Is that fair that the seller pays the buyer? And then this way, this is that much less money that the buyer has to bring to closing. So because they get this money from the seller at settlement, they have it and are prepared to pay those taxes. Guys, let's imagine this. If we didn't do this, the tax bill comes out, in September, and the buyer goes to pay the taxes in November, and they call the seller and they say, hey, man, our taxes are due for the year. You need to send me some money. And what's the seller going to say? And they're going to hang up, right? This is why we need to settle everything now. So the buyer has that money. Is this making sense? This is why we're hashing and settling everything now. So one scenario you're going to see is something that's unpaid, debit the seller, credit the buyer. Who owns the property for longer this year? Who owns it for longer, the buyer or the seller? The buyer. The buyer owns it for more, right? The seller owns it for 135 days. The buyer's going to own it for 225 days this year. So the buyer owns it for more this year. So isn't the buyer's portion of taxes going to be more than the seller's? Yeah, because they owned it for longer. I think that's something else that the timeline helps us with. Guys, some of these problems, you may not need to pick up a calculator. Some of these problems, if you just look at the numbers and you can figure out who owes whom, and you know whose responsibility is greater, you may not even need to pick up a calculator. Isn't that nice? Math that you don't have to do. How about that? questions so far. Debit the seller, credit the buyer. This is one thing we could do if taxes are unpaid. The other thing we may see if taxes are unpaid, put prorating aside for just a second. Put prorating aside for just a second. The other thing we may see if taxes are unpaid is something called a double debit. A double debit is not a proration. Remember what we said. A true proration is a debit to one party and a credit to the other for the same amount. You may also have a case where the problem tells you they're unpaid and they may want you to do a double debit. Again, I think it's good to draw it out. Let's see our picture, see what we're visualizing here. And now let's go to closing today. Who remembers when does the tax bill come out each year? Or when's the tax bill due? Let's say when's it due? Back to Unit 3. When's the tax bill due each year? Yep. Got a couple of you coming in. The tax bill is due on September 1st every year. So if you have guys, this is really important. If you have a closing before September 1st, the problem may or may not tell you if taxes have been paid. But if closing happens before September 1st, have taxes been paid? There's no way, because they're not due yet. We can't pay them in March. We don't even get a bill till August, and they don't come due until September. Do I have everybody? So if you do a double debit, if you see a double debit, first off, I'm telling you, closing is going to be after September 1st. So if we go to closing today, what the attorney may do, instead of prorate, they may do a double debit in which they debit the seller for the period of time that they own the property, and then they debit the buyer for the rest of the year. The seller gets a debit for those numbers of days. The buyer gets a debit for those numbers of days. This is not a proration. This is a double debit. The deciding factor on this is, when is the tax bill? When is closing in relation to the tax bill come out? Does that make sense? So September 1st is an important date. Again, you guys, the problem has to tell you when closing is. Closing is March 15th. It may or may not tell you if taxes have been paid. We need to know if you go to closing before September, there's no way the taxes have been paid. Who owned it for longer this year? Yeah.
Okay. I actually bought a house May 1st in North Carolina. So the seller forwarded me the tax bill somewhere around July and said, you owe this taxes by September 1st.
That I have never heard of that before, and you're not going to see that. I have no idea what that situation is about. I don't know.
Do you understand what I'm saying though?
I do. And I'm telling you, I've never heard it before in all my years. So I don't know. I don't know the answer to that. But what I do know is for your exam, right? The buyer and the seller are going to settle things at settlement.
Okay.
So, yeah, I've never, ever heard of the seller forwarding, especially when you bought in May. Why is the seller getting that? I got a whole lot of questions about that we don't really have time to get into right
wouldn't her application or sales contract have that in there, like what that was actually for? It should.
I have no idea. I would think it would, but
okay.
I have no idea. I've never, ever heard of that happening. So yes, ma'am.
So the double debit would only happen after September 1st, correct?
And if taxes are unpaid.
Got it. Thank you.
Yep. Okay. So debit the seller. And guys, please, I apologize. I'm really not trying to be mean, but can we see how our real life can confuse things for the exam? So I know you all have experience, well, some of you have experiences, or you know somebody that has experiences. So I know we want to rely on our experiences, but I fear sometimes our experience confuses us for the exam. So attorneys, buyers, and sellers, they can agree to whatever they want to. So was it in your contract? I don't know. Is that something the attorney decided to do? I don't know. Was the seller trying to take advantage of the situation? I have no idea. But what I do know is if things are unpaid prior to settlement, it's either going to be a debit the seller, credit the buyer, or it's going to be a double debit after September 1st. Unpaid. The other scenario we may see for prorating, back to prorating, is if something was prepaid before settlement. Taxes have already been paid. Again, every time you guys prorate, draw your timeline. See your, are you guys here? Do I have you guys? Yeah, okay, all right. I'm being funny on my end. There we go. So if taxes are prepaid, that means closing has to happen after September 1st, right? The seller can't pay the bill if they don't have the bill yet. So it could be that the seller got the bill on September 1st and then paid taxes. So if something's prepaid, we're looking at closing again after September 1st. So let's see, now let's go to closing on, let's buy yourselves a Christmas present and go to closing on December 15th. Seller owns the property the front part of the year. Buyer owns the property the latter part of the year. Again, you guys, what divides this timeline is the day of settlement. So if taxes have been paid prior to settlement, the seller's already paid the entire bill for the entire year. Stop and ask yourself, who owes whom? The seller's paid the bill for the whole year. Who owes whom? Now we're going to do a debit the buyer. That's right. Credit the seller. The buyer owes the seller for the period of time that they own. Seller gets the day of closing. So the buyer starts paying tomorrow to the end of the year. I always remember that this way. When we wake up the morning of closing, whatever day we're going to closing, when our alarms go off and we wake up that morning, the seller still owns the property. And if everything goes according to plan today, when we wake up tomorrow, who's going to own the property? Well, we're still calling them the buyer, but now they're the brand new owner, aren't they? You guys with me? So the seller pays, because when our alarms went off this morning, the seller's going to be the one to pay that. So the seller pays the 15th, the day of closing, which means the buyer's responsibility starts tomorrow, in this case, through the end of the year. Let's talk about counting for a second. It's really easy to get this problem wrong because you don't count right. When you're counting forward on the timeline, I have a highly sophisticated method to help you guys get the number of days right. Y'all ready for my deep, dark math secrets? Count it out on your fingers, because it's really easy to look at that and see 14 days, but let's count it out together. You got the 16th, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, and 30. How many days does the buyer owe the seller? Not 14. They owe the seller for 15. Y'all get the problem wrong because you don't know how to do it. Don't get it wrong because you don't count right. Come on. You got these tools. They cannot take these away from you at PSI Testing Center. Count it out. Count it out. Questions on how I got 15? Then you just take your annual taxes, divide by 360 to get daily. Whatever that daily amount is will show up as a debit to the buyer, credit to the seller. See? No shame in counting on your fingers. None. So let's go back to page 561. 561 kind of gives you a breakdown of what we just talked about, except with the double debit. I don't know that you guys will see a double debit on your exams. But just in case, and you got some practice problems, so I do like to throw it out there. But I think what you're more apt to see is going to be a debit to one party and a credit to the other. So it gives us the summary of items to be prorated on page 561. And this is what happens when your taxes are unpaid, prepaid, when your rent, owners association or HOA dues. Questions?
I have a question.
Yes.
So, and I don't know, maybe I'm thinking too much into this, but so I'm calculating what you just calculated and I keep getting 14 and I'm trying to figure out what in the world I'm doing wrong. Cause you said start at 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 29. I keep getting 14.
So let's do it together. You got the 16th, 17.
So we are counting the 16th.
Yes.
Okay. So I guess, I'm sorry, I don't.
Seller pays the day of closing. Buyer starts paying tomorrow.
Okay. So we are, okay. I'm going to have to think about this because I guess the debit buyer credit seller is getting me.
So the buyer owes the seller for their period of time, the period of time that they own the property. So if we go to closing on the 15th, the seller is responsible for taxes today. So the seller will pay taxes on December 15th.
Okay, so your 1216 is basically just showing the timeline.
Correct. That's the when the buyer owned the property this year, December 16th to the end of the year. Yep.
Okay. All right. Thank you. I just was so confused.
Sure.
Thank you.
Thank you. Okay. Yeah, so somebody says if we were going to November, if it was November 15th, we'd have, what did I just say, 15 days, 16 days, how many? What do we count? 15 days left in November plus 30 days in December, right? You got to go from the day after closing to the end of the year because that's what the annual property taxes are, aren't they? January 1st to December 30th. One thing I asked you guys to do this past week, and I hope you were able to spend some time with it, is page 562. I'm not going to spend a lot of time here in class because you got page 562. I mean, I'll make a copy of it, take a picture of it with your phone. I don't suggest you ripping it out of your book because once you do that, your whole spine breaks and your book starts falling apart. So take a picture of it with your phone so you can look at it everywhere you go. But what we're doing on page 562 is identifying things that are typically debits and credits to both parties. So 561 and 562. Things that you're going to see that are typically debits to the seller. If you can remember your alphabet, you can remember C, D, E. The seller is typically responsible for paying commission. The seller is responsible for having the deed prepared. It's still their deed. They have to pay the attorney to get it ready for closing. The seller is typically responsible for excise tax. We talked about excise tax back in Unit 5. The seller will have a debit back on page 561. The seller will be debited the due diligence fee. They've already received this money once. The seller received the due diligence fee when we went under contract, however long ago that was. So now that we're here at settlement, we need to reverse that charge. Does anybody have an accounting brain? Where are my accountants? Nobody likes to admit that. Nobody? Well, here's accounting 101. What's the opposite of a credit? How do you clear out a credit? C-R-E-D. How do you clear out a credit? You clear it out with a debit. The seller received that money when we went under contract. So now that we're at closing, we need to reverse that charge and debit the seller for the due diligence fee. The sales price is always going to be a credit to the seller. That's the whole gist of our 16-page offer to purchase and contract. The buyer promises to pay the seller in exchange for the property. So the sales price will always be a credit. I apologize. Let me say something back up here. When I say the seller typically is responsible for CDE, once again, you guys, please always do what the problem tells you. If the problem doesn't specify who's paying commission, then charge the seller. But if the problem says that the buyer's going to pay commission, do what the problem tells you. That's what I mean by typically. The seller typically pays commission unless you're told otherwise. Who owes more when they're buying, when in the transaction? Who's going to owe more? Who has bigger debts, do you think? The buyer or the seller? Who has more debts? Who owes more money? Probably the buyer. They have a lot more debts. They have a lot more, which is why their debit list looks a lot longer. If I were you guys, I would focus more on the seller's debits and know that everything else is going to be for the buyer. So the buyer is going to be debited the sales price. Again, that's the whole gist. That takes us 16 pages to say this. The buyer is responsible for the sales price. Anything related to the buyer's due diligence period. So the home inspection, the pest inspection, the survey, septic test, septic inspection, radon test, anything that the buyer chooses to do during their due diligence period will be a debit to the buyer. Anything to do with the loan, lender's fees, are going to be a debit to the buyer. This relationship is between the buyer and their lender. The buyer owes the lender for, we talked about discount points, loan origination fees. We're getting to talk about something called interim interest. The buyer hires the attorney. I'll do it right before we go to break. The buyer hires the attorney. So the buyer gets to pay the attorney's fees. The buyer gets to pay to have their brand new deed and the lender's deed of trust recorded. Problem topic. The seller pays to have the deed prepared. The buyer pays to have the deed recorded. And then the buyer will typically be responsible, if they get title insurance, for paying both policies, their policy and the lender's policy. That will show up as a debit. So again, I just took page 562, 561 and 562 and broke it down. I've been requested to go back for 1 second, so. The buyer, you may also see some things that are POC. POC means paid outside of closing. If it's paid outside of closing, it means that it's already paid. Unless you're told otherwise, the appraisal has already been paid and the credit report fee from the lender has already been paid. So when you see these on the mini CD, don't put them on there again. The buyer's already paid them once. The appraiser is not going to go out and do their thing until they've been paid. The lender is not going to pull a credit report fee until they've received that money. So POC, this is another way they like to distract you. They like to put things that are typically debits to the seller. They also like to put POC. And let's always do what the problem tells you. I cannot stress that enough. And then we have things, the buyer does get a few credits. The buyer's new loan today is going to be a credit. Let's think this through. Shake your head one way or the other. Can you buy my house today without the funds from the lender? Pretend you're not a cash buyer. Can you buy my house today without the funds from the lender? Can you? No, you need the lender to bring that money for you on your behalf, right? That's what this is all about. So you apply for a 90% loan. The lender shows up with 90%. You have your cute little 10%. 10% doesn't satisfy our contract, does it? In order to satisfy our contract, I need 100% in exchange. So the buyer brings money and the lender brings money on the buyer's behalf. Once again, let's think of settlement, kind of a snapshot of today. Today being the day of settlement. Today, the loan is a credit to the buyer. Tomorrow and for the next 30 years, the buyer's going to pay them back. But you got to bring the money. The due diligence fee and the earnest money are also going to be credited to the buyer today. Remember when we went under contract, we told our buyer, you pay this earnest money, you pay this due diligence, and they will be credited to you at closing. So now we're doing what we said we would. Again, you guys, this is just taking 561, 562 and breaking it down. I really suggest you're welcome to look at these 2 pages while you're doing practice problems. I hope in time you can start weaning yourself off. But that's the key. That's the key to doing these, is knowing what's a debit to whom and a credit to whom. What questions do I have so far? Okay, let's take our break. When we come back, we're going to talk about something called interim interest, and then we're going to do our settlement statement. Can you please remind me next break? How are we doing so far? So far, so good. Good. I like thumbs ups. All right. So let's take attendance. And, oh, Jose, I just got you. You're in. Okay. And I have taken attendance, so I'm seeing cameras come back on. So if you're back, please let me know. Okay. One more thing to talk to you guys about before we jump in and do one of these things. The other thing we need to have, that's why I set a timer, because some of you question me if I'm actually giving you 10 minutes, because you say they go by too fast. So I set a timer. See, I have proof. I don't speed the clock up. I know it does go by fast. So the last thing we have to talk about before we jump into this is something called interim interest. Interim interest is interest that the buyer owes their lender. Interim interest is the buyer getting caught up on their interest. Let's talk about this. Whenever we go to closing, here's another picture, another timeline. Let's pretend, let's be reasonable here. Let's pretend that we're going to go to closing later this month. We're going to go to closing on November 20th. Anytime we go to closing, the borrower does not have a mortgage payment the month after they originate a new loan. So anytime we go to closing, whenever the buyer originates a new loan, they always skip the first. Mortgage payments are due on the 1st. They do not have a mortgage payment. They skip the first. So if we go to closing on November 20th, the buyer does not have a mortgage payment on December 1st. Their first mortgage payment will be January 1st. Happy New Year. Whenever the buyer originates a new loan, we skip the first. The reason being, interest is always paid in arrears. Anybody remember what that word means? Arrears. Where's your rear? Where's your rear? It's behind you. So when you make your mortgage payment, your first mortgage payment on January 1st, you're paying December's interest. If closing is on the 1st, you skip the first. You always skip the first. February's mortgage payment means you're paying January's interest. March, you're paying February. Everybody with me? That's what we mean by arrears. Where's your rear? Your rear is behind you. I told you guys, I got you doing some dumb stuff at PSI, don't you? I got you counting on your fingers, and I got you looking to see where your butt is. Whatever helps. Interest is paid in arrears. Put yourself in the lender's shoes for a second. Let's put our lender hat back on just for 1 second. If you're originating a loan on November 20th, and you know you're not getting interest for December until January, as the lender, aren't you asking yourself, whoa, what about the interest for the rest of November? And that's what interim interest is. The borrower is getting caught up on their interest payment. As you, the lender, don't you want interest from the 20th to the end of November? Yeah, that's why you originated that loan. Everybody with me? So interim interest is always, hear my absolute word here. Interim interest is always the day of closing to the last day of that month. Never, ever go into the next month. Interim interest is always the day of closing to the last day of that month. If closing's on the 30th, how many days is the buyer owe for interim interest? Just one. The day of closing to the last day of that month. And in this case, I am not prorating between the buyer and the seller. This is not about the buyer and the seller. This is about the buyer and their lender. Do they owe interest to their lender on the day of closing? You better believe it. Interim interest is always the day of closing to the last day of that month. So how many days does the buyer owe the lender? The 20th, 21st, 22nd, 23rd, 24th, 25th, 26th, 27th, 28th, 29th, and 30. There's 11 days. Questions on this piece so far? We're going to talk about the rest of it in a second. How much? How did I get 11 days? The second piece of interim interest is to figure out how much. You guys remember when we amortized and we broke it down into monthly, we used those 3 steps and we did them over and over and over again. One of those steps was to calculate annual interest. So to calculate annual interest, you take your balance or your loan amount times the interest rate, and that gives you annual interest. Does this look familiar? You guys remember when we did this? Back when we amortized, we needed to take annual interest and break it down into monthly. So we divided by 12. Now we need to take annual interest and break it down to daily. So now once we get annual interest, we're going to divide by 360. And that gives us just pretend all that's spelled right. I don't know if it is or not. Just pretend that it is. Will you guys hear me there? I'm typing fast. Thank you. Thank God I'm not giving a spelling test, huh? Grammar test. Woo, you guys would be in trouble. Okay. Now that we have daily, we take that daily interest times 11. Whatever that amount is, will shake out as a debit to the buyer. It's money that they owe their lender. Questions on interim interest? And we'll see this in practice. We're getting ready to do one. A lot of real estate agents in practice, a lot of real estate agents will try to get their buyers to close on the last day of month for this very reason. So that way their buyer only has a charge of 1 day. Sometimes that works out, sometimes it doesn't. Me personally, I stay away from the last day of the month. Why? Because that's when all y'all are trying to get scheduled.
Yeah.
Yeah.
So, and maybe I'm behind, but it's okay. So balance times interest rate, annual interest divided by 360 equals daily interest. So this can be in a T, right? Like you can.
I haven't figured that out yet.
So that you don't
So
know that.
I would think the formula would be easier. Balance times the interest rate equals annual interest. I could do a T-bar. Solve for the X on top, the part. Sure, there's your T-bar. If you want to make that into a T-bar. I think I prefer the formula here. And guys, please know when I say balance, it's the loan amount. So today, on the day of settlement, it is the loan amount. How much is the lender bringing times the interest rate? Interim interest. Questions? Okay. So let's bring this all home. What does this mean for us? Why do we care about this? Well, I've already told you, it's part of OLCAR. We're going to OLCAR. The Real Estate Commission says we need to possess a very thorough understanding of these settlement statements. This is one of the best things we can do to protect our clients. Guys, buyers and sellers don't understand these settlement statements. Buyers and sellers don't know these numbers. They don't know where they come from. That's why they have us. We have a duty to verify the information that we have actual knowledge of. I think we talked a week ago. When you get a settlement statement to review for accuracy, the very first thing you're going to do is pull out your sales contract. Make sure that the purchase price is right. Make sure that the due diligence, the earnest money, seller pay closing costs. Is there an amendment to the contract? Did we renegotiate the purchase price? Do we have additional earnest money? So the first thing you're going to want to do is go back to your paperwork, verify those numbers. You probably, let's say, for example, when the buyer had their home inspection done, a lot of home inspectors will allow buyers to pay for the home inspection at settlement. Now, they may give you a 10% discount if you pay in cash today. Not all buyers have that cash laying around. So a lot of home inspectors will allow the buyer to pay for the home inspection at settlement. The home inspector is going to send you the invoice, you, their agent. They're going to send you the invoice, and it's your duty to forward it on to the closing attorney to make sure that it gets put on the settlement statement. Once you get an invoice, can't you verify that it's correct on the settlement statement? Can't you go back to that invoice and say $495, $495? This is why we mean by things that you have actual knowledge, things that you can verify. Some things that you cannot verify. For example, I probably was not privy to the conversation that my buyer had with their lender. I didn't hear the lender say how much they're going to charge, what their fees are, that kind of thing. I wasn't involved in that conversation. So I can't verify the accuracy of that. I can look at it and make sure it looks normal. Once you do a few of these, you'll know what normal looks like. But we're responsible for verifying the accuracy of entries of which we have actual knowledge. When we're reviewing these settlement statements for our clients, we always need to look for red flags. You're going to find mistakes. Humans prepare these things and humans make mistakes. You're going to find mistakes. And when you find a mistake, you have a duty to contact the attorney and or the lender, whatever the case may be, and correct it. That's OLCAR, making sure that the buyer's final, how much do I have to bring to closing, is accurate. Guys, I've seen additional earnest money missing. Is that a disservice to my buyer if I don't get them all their credits that they deserve? Absolutely. Y'all hang on to your chair. Grasp your chair for a second. Hang on. Y'all ready for this? As a listing agent, I reviewed a settlement statement once and my commission was missing. What the heck would have happened if I wouldn't have caught that, right? I called the paralegal. I said, the buyer's agent was Mike. I said, Mike and I want to get paid. And she said, and I quote, oopsie. That just hurts me to hear you say that. Guys, we have a duty to verify these things. This is OLCAR. That's that A in OLCAR where we owe them accounting. As we said, we can verify that debits and credits are properly charged. What's a debit to the buyer, credit to the seller? Any number from the sales contract, purchase price, due diligence, earnest money, seller pay, closing costs. By the time I'm done with you guys, you'll know how to prorate. You can make sure your prorated items are accurate, your interim interest, excise tax. If nothing else, you can just add bottom line figures. And then any unpaid invoices, again, that we have knowledge of. The home inspector sends you the invoice for you to forward it on to the attorney. Because you have received that invoice, you now have a duty to verify it. I once had a pre-licensing, and this takes me back to class when we first started. Somebody came on class right at 9 and said, your realtor friend told you, you said, do we really have to do this? And your realtor friend said, oh my gosh, yes. So if you want a closing and you're working with buyers and sellers, then we need to know how to do this. I once had a pre-licensing student ask me, do you actually do this? To which I responded, yes, hell yes, I do, because that is OLCAR. That's the duty that I owe my buyers and sellers. If you don't review the settlement statement and or you don't report when you find errors, not only could your client, take you to court and sue you for the lost money, but you could also face disciplinary action by the Real Estate Commission. Why? Because this is OLCAR. This is accounting right here. I know sometimes we get shy and we don't like to call people and say, you made a mistake. We got to call people and say, you made a mistake. And you can go about it nicely. Please remember the paralegal and the lender and the attorney, they're all human too. Do you guys make mistakes? Do you ever make a mistake? They do too. The thinking here, the theory here, you guys, is the more sets of eyes we can put on these things, the better chance for accuracy we're going to have. So that kind of gets us through Unit 21. I'm going to go off PowerPoint. So we're going to wrap this up real quick. Those key terms that we started a week and a half ago, we talked about things like RESPA. We talked about the closing procedures, the buyer's due diligence. There's your key point review, good summary, a good review on page 563. Student quiz. That does include some of the math. Math concepts, we showed you that section on 556. These are those 50 problems in the back of the book, starting on page 803. These are the numbers that relate to the math in Unit 21. And then, of course, we got some stuff for you guys at Learn, Test, Pass, one of them that we're getting ready to do. So please take just a second and jot down these numbers. You guys got them? Everybody good? Good, good. Okay. Are we ready to do one of these? Yay! I hear you. All right. So first off, where we are, we're in Learn, Test, Pass, the Unit 21 material. And you can see I got a couple. Here's mini CD1 with the answer key, 2 with the answer key, 4 and 5 with the answer key. So I give you 4 just here in Learn, Test, Pass. Plus you got some more, I think, in one of these quizzes. And I know you got a few in the book as well. So I think you guys got enough practice to get you guys started. Where is mini CD3, you may ask? I think mini CD3 is harder than anything you're going to see on your exams. So I chose not to put it in there. If you're up for the challenge, just send me an email. But why don't you get through 1, 2, 4, and 5 and a few other ones first before you tackle 3? Fair enough? All right. So the one that we're going to do in class together is mini CD number 1. So we're going to work through this one together. We are recording. I do encourage you guys to go through at your own pace. Practice, practice, practice. I cannot stress that enough. And once again, I cannot stress the importance of 561 and 562 in your book. That's your key. That tells you what's a debit to one party and a credit to the other. When you guys start doing one of these, the first thing you're going to do is take your scratch paper and draw a line down the middle. And on one side of your scratch paper, you're going to put credit. And on the other side of your scratch paper, you're going to put debit. Before you even touch the problem, take your scratch paper. One side is credit, one side is debit. And what we're going to do is we're going to go through this problem in order, and we're going to figure out what's a credit and what's a debit. Once we identify, go through the problem and identify debits and credits, we're going to add up all our credits, add up all our debits. Debits minus credits will tell us how much the buyer has to bring to closing. So I'm going to go against my grain here just for a second. Instead of standing here reading all this to you guys, because we're getting ready to break it down, let's just skip ahead to the end. What's this question asking me? How much does the buyer have to bring to settlement? Do I care about the seller? Do I care anything at all about the seller in this problem? No, it's all about the buyer. Again, when you guys do these, start at the top, work your way down, go in order. Please don't skip around, because when you skip around, you skip something. So go from top to bottom, work your way down. Again, all we're going to do is identify what's a credit to the buyer and what's a debit to the buyer. So the buyer enters into a purchase contract with the sellers for $210,750. Tell me, I can see your mouths move. Is the sales price a debit or a credit to the buyer? Sales price, debit or credit? It is a debit. It's how much the buyer owes the seller. For what? If I give you $210,750, what are you giving me? Your property. 16 pages in a contract to say that. The buyer's paying the seller in exchange for the property. The purchase contract, the purchase contract provides for November 24th settlement. I tend to like to write my settlement date at the top of my paper because I know I need to refer back to that date. I know I need to reference that date. So you may want to jot it down somewhere where you can find it easily. Save yourself some precious test time. Then it says, the seller has paid taxes prior to closing and will be prorated at settlement using the 360-day method of $2,610. As soon as I see prorate, before I even pick up my calculator, I draw my picture. This is our annual taxes. The dividing factor of the taxes is the day of settlement, which in this case is November 24th. The seller owned the property the front part of the year. The buyer owns the property the latter part of the year. Okay. So the seller has paid taxes, which means they've already paid them. Taxes have been paid. So now we need to stop and ask ourselves, if the seller has paid the entire year, who owes whom? Why don't you guys tell me in a chat, private chat, who, and you can say B and S. I understand B and S is buyer and seller. Who owes whom? And I'd like to hear from all of you, please. Who owes whom? Yep. Look at you guys go. So the buyer owes the seller for the period of time that they own the property. And the buyer's period of time starts tomorrow and goes through the end of the year. So how this is going to shake out is you guys just show me the buyer owes the seller, which shakes out as a debit the buyer, credit the seller. The buyer owes the seller for this period of time. Questions so far? So now we have to figure out how much, right? I have days left in November. So if they're starting on the 25th, we're going to count the 25th, the 26th, the 27th, the 28th, the 29th, and the 30th. We got 6 days left in November, 30 days in December. So the buyer owes the seller for 36 days of taxes. 6 days in November, 30 in December. The buyer owes the seller for 36 days. The problem tells me that my annual taxes are $2,610. I need to break that down to daily. And I get $7.25 a day. We just figured 36 days. So total, the buyer owes the seller, debit the buyer, credit the seller, $261. Debit the buyer for their portion of real property taxes. And that's the sale price. Again, once you draw the timeline, it's very easy to see who owned the property for less this year. The buyer, they only owned it for 36 days, right? So who owes for less this year? The buyer. I think sometimes before you get excited and pick up a calculator, I think sometimes you can look at these answer choices and maybe rule something out just based on the amount. The buyer has the lesser responsibility. Questions? Yay, you. Good, good, good. Several of you, good. What questions do I have? Prorating. Draw it out. To me, you guys, I'll be honest. To me, the hardest part about prorating is figure out what's a debit to whom and a credit to whom. Who gets what? And so for me to draw it out and see it and then stop, breathe, and ask yourself, who owes whom? Once you figure that out, you know which end of the timeline you're on. By the way, I do, and I apologize I didn't do this with the sales price, but I do generally like to label my work, again, as a time-saving thing. If you ever need to go back on your test, it's helpful to know off the bat that this is the sales price. This is prorated taxes. So I do generally like to label my work as I go. Questions? No, looks like that's gone away. Then we're told debits and credits for the following items should be made to common practice. Earnest money deposit, $4,500. Move your mouth. Is that a credit or a debit to the buyer? Earnest money deposit. It is a credit. We told them that when we went under contract. You pay this earnest money deposit, you'll get credited back to you at settlement. So this is EMD. Financing is our loan. This buyer is getting a new $175,000 loan. Is the loan amount a debit or a credit to the buyer on the day of settlement? It is a credit. The lender is bringing the money on behalf of the borrower. The borrower is going to spend the next 30 years paying them back. Do you expect to be paid back something you don't receive? If I just tell you to start paying me, you're going to be like, for what, right? If I want you to pay me, I need to give you money. That's what's happening. The lender's showing up today, and the buyer will pay them back over the next term of the loan. A new conventional 30-year mortgage loan with a fixed interest rate of 7.5%. We're not far away from that anymore, are we? Hang on to that interest rate. We will come back to that in just a second. We'll need that in just a second. The lender is also charging a 1% loan origination fee and 2 discount points. Please remember, lender charges are always of the loan amount. Of the loan amount. What does the word of mean in a word problem? Multiply. So I know I have my loan amount of $175,000. There is a 1% origination fee. And then we also have 2 discount points. 2 discount points is equal to what percentage of the loan? 2 discount points is equal to 2% of the loan. So I have debits to the buyer money. They owe their lender $1,750 loan origination fee and 3,500 discount points. Anytime you're dealing with the lender, it's going to be of the loan amount. Remember, the lender cares about their money. Questions on loan origination fee or discount points? Then we have interim interest through November 30th on the borrower's new mortgage. So if we're going to closing on November 24th, why don't you guys tell me in a chat, when is the borrower's first mortgage payment going to be due? If we're going to closing on November 24th, when will their first mortgage payment be due? November 24th. We skip the first, which means there is no mortgage payment on December 1st. Their first mortgage payment will be Happy New Year. January 1st. Interest is paid in arrears. So when they make that payment in January, they're paying December's interest. So interim interest is just the borrower getting caught up on their interest. They owe the lender from interim interest is always the day of closing to the last day of that month. Never, ever, ever go into the next month. If you do, you just double charge your buyer. Do you have a happy buyer if they have to pay interest twice? No. Interim interest is always the day of closing to the last day of that month. So how many days? Are you ready? Let's do it together. You got the 24th, 25th, 26th, 27, 28, 29, and 30. So how many days does the buyer owe their lender for interim interest? 7. Please count it out. Questions so far? Now we're going to figure out how much. We're going to take the balance, which today is the loan amount, times the interest rate, which is what we just kind of glossed over real quick. And now we're going to come back and get. So I know my interest rate and I know my balance. 175,000 times 7.5% gives me annual interest of $13,125. Balance times the interest rate gives me annual interest. Take annual interest and divide by 360 to get daily. Let's talk about rounding for a second. You guys get so stressed out about rounding, and you don't need to do that. Get stressed out about other stuff on this test, but not rounding. They say, once again, whoever they are, they say that if you round out at least 3 decimal places until you get to the end is where you're going to have the most accurate number. So if you need to round to 3. So I get like 36.45833333333. So I rounded to 45.8. If you want exact, if you need to the penny, don't clear your calculator. So once you take 13,125 and you divide it by 360, you get 36.458333333. Then you just say times 7 on your calculator, times 7. Then you get 255.208, whatever. And now we'll round because we're at the end. Guys, please listen to me. This is so very important. Please listen. You're not going to miss a problem by rounding alone. So in other words, if you got 22 cents, they're not going to have both of those as answer choices. They're mean, but they're not cruel. So as long as you don't get carried away with your rounding, in other words, don't just go nuts and go to whole numbers, right? Stick to at least 3. You may have an answer choice off by $36.45, banking on you counting your days wrong. So you're not going to miss a problem by rounding alone. You may miss a problem by not counting right. Does that make sense? So best suggestion for rounding I have is to go out 3 decimal places until you get to the very end. Now that we're at the end, we rounded to get that 255, debit the buyer, 255.21. And this is for interim interest. So let's see, with taxes, you do not count the first day because settlement is paid. That's right, because with taxes, we prorate between the buyer and the seller. And when we prorate between the buyer and the seller is responsible for the day of closing. Interim interest is not prorating. Interim interest is not between the buyer and the seller. Interim interest is the buyer paying their lender the interest that they owe through the end of the month. It's not prorating. It's a debit to the buyer. What does the seller care about the buyer's loan? All they care about is what? Can they get approved? They don't care about the terms. They're not involved in that. That's between the buyer and their lender. Thank you. Interim interest. Let me say this before I forget to. You're going to see this is one of your test questions. How much does the buyer have to bring to closing? You may also see a standalone and independent proration question or a standalone interim interest. So learning how to prorate and learning how to do interim interest is not only going to help you with this big one, but you may also have a math question, just what is the buyer's interim interest or what is the prorated amount? Questions? Private mortgage insurance, a conventional loan has private mortgage insurance and 80% or higher loan to value ratio. This PMI for the first year is due at closing, and the lender is going to collect 0.40% of the loan amount. What's the word of mean? Multiply. So the loan amount of $175,000 of 0.40%. Y'all don't forget that point right there. That's very important. 175,000 times 0.40%. So PMI, in this case, some lenders will divide it by 12 and attach it to your monthly payment. This lender chose to collect the first year at settlement. So there'll be a debit to the buyer, $700 for PMI. Borrower's homeowner's insurance annual premium, $444 to be paid at closing. Sometimes if you pay attention to the problem, it'll tell you what we're going to do with it. Let's just talk about homeowner's insurance real quick though. Anytime you may pay homeowner's insurance, you're always paying for coverage in advance. So when you make your car insurance payment, you pay for coverage for the next 6 months, right? So at settlement, your homeowner's insurance is the same way. Your annual policy, you pay it now to be covered for the year. So the insurance company is always going to charge the buyer the full amount for the first year. So they have coverage starting today for the buyer. And then they are covered through November 23rd of next year. When that bill comes due, they've collected money in the escrow, they can pay to renew in the borrower's behalf. You're always going to have an annual charge for, I mean, your medical insurance. My medical insurance comes out the first of the month and it covers me for that month. Insurance is always paid in advance, for advance. And this is no different. Move your mouse. Oh, yes. Yes, ma'am.
Sorry, I feel like I'm doing something, just a stupid mistake. I keep getting 70,000 when we're doing the
because you didn't do 0.4. So
it's 175,000 times 0.4, right?
0.40%.
0.40%. What am I doing wrong here? 175,000.
I'm getting the same thing.
0.70.
You have to turn that into a decimal. So it's already 0.4 as a percentage. So in order to multiply with it, you got to put
times 0.40%.
0.004. Got it. Okay, I see. Yeah. Thanks, Andrew.
Okay. So 0.004 or 0.4%. That's right. We're saying the same thing here. 0.40. Yep. Either one. However you see it. Thank you. Okay. Is the due diligence fee a credit or a debit to the buyer? Due diligence, credit or debit to the buyer? It is a credit. Remember what we told them when we went under contract. You pay this due diligence fee, you pay this earnest money, and they will be credited back to you at settlement. The buyer hires the attorney. So the buyer gets to pay the attorney's fees. Title insurance, protects the owner. Today, they're the buyer. Later today, they are the owner. The buyer has to purchase that title insurance policy at settlement for them and the lender. It's a one-time fee. They only have to pay it once. It covers the buyer for as long as they own the property. It covers the lender for as long as there's an outstanding loan. Buyer gets to pay both. Deed preparation fee. What am I going to do with that? Deed preparation fee. Deed preparation fee. Tricky, tricky. That is a seller debit. There's your distractor. Seller pays commission, deed preparation fee, and excise tax. Do you see what they like to do to you? This is not me being mean. Once again, kind of like Kahoot. I can make this super easy. But what does that do for you? Seller pays to have the deed prepared. Again, you guys, I can almost promise you there's going to be one of these answer choices that is off by $65, banking on you putting it in. So I cannot stress the importance of knowing the pages on 561 and 562 for this reason right here. However, the deed recording fee, now we're back in business, aren't we? What do we do with the deed recording fee? That's going to be a debit. That's right. Debit the buyer. Everybody see the difference in preparation and recording? I always remember it this way. When the attorney is getting the deed ready for closing, it's still the seller's deed. So the seller gets to pay to have the deed prepared. It's in the buyer's best interest to get their brand new deed recorded. So they will pay to have that recorded. Survey, part of the buyer's due diligence cost. So that's going to be a debit the buyer. And then there's always some kind of courier fee or wire transfer fee or some other kind of nickel and dime you to death, you know, some kind of other fee thrown in here. When you see words like fee, interpret that as a debit. It's money that you owe. It's money coming out. So whatever it is, whatever they want to call it, it's a fee. So it's money that you owe. So in this case, there's a $25 courier fee. I'm going to pause for just a second. We're going to take a break. When we come back, we'll talk about this loan escrow. So we'll finish this up after break. But before we go to break, do you have any questions just on what we've looked at so far? So unfortunately, I can't erase. So we're going to have to just kind of bear with me on this clock. Can you guys still see this okay? All right, so let's take 10. When we come back, we're going to finish this thing out. back. I'm going to take attendance. And in my effort to protect my work, I ended up losing my work. So I tried to come in here real quick to redo everything. So y'all check my numbers real quick about what against what you have. Make sure we're good. I know what happens when I try to do things fast sometimes. Welcome back. Welcome back. Do my numbers look like what you guys have? Okay. Right, good. Okay, thank you. Thank you. I tried. Okay, so the last piece of this that we need to talk about is the loan escrow. We talked about the escrow account. Make sure you tell me you're back. Yep, thank you. So the last thing, well, we talked about the escrow. And the escrow, the lender has an escrow account like for each borrower. And every month, part of the payment that you send to the lender, your PITI, remember we talked about that T&I, your taxes and insurance. So every month that you make your payment, 1/12 of your taxes and 1/12 of your insurance is loaded into your escrow account. So when those bills come due whenever they're due, the end of the year or whatever, when those bills come due, the lender has the money in escrow to pay those bills on your behalf. So that's the piece of the escrow account that we've talked about. Now we need to talk about creating and setting up the escrow account. In addition to the first year's insurance, and in addition to prorating this year's taxes, we're also going to have to find amounts for the lender to put into escrow and into insurance. They have to originate the account, and they want a little bit of cushion. In the event that those amounts go up next year, they have a little bit in your account that they can still pay those bills on your behalf. Is it a really good chance that taxes can go up next year? Do taxes go up sometimes? Yeah. Is there a really good chance that insurance can go up next year? Does insurance go up sometimes? Yeah. I guess they could come down, but I think typically what we see is they go up. So in the event those bills go up next year, the lender's going to collect money up front at settlement to originate the escrow account and to give themselves a little bit of cushion. So the buyer's going to have debits for loan escrows. In this case, 4 months of taxes and 2 months of homeowner's insurance. Please don't worry. When you pay your loan off or when you sell your home, if you have anything left in escrow, that money will be credited back to you. It's a holding ground. It's an impartial place to keep the money so they can pay those bills on your behalf. I think I've told you guys, we paid our condo off the end of last year. And after I paid that off, like 3 weeks later, I walked out to my mailbox and I had a check. And I said, well, this is nice. What's this for? It was from my lender reimbursing me the money that I had in escrow. Does that make sense? So it's your money. It's your money. And you'll get it back if there's anything left. But the lender just needs something to get started. So in this case, they're going to collect 4 months of real property taxes and 2 months of homeowner's insurance. And the only thing that we have to go on to calculate that is this year's taxes and this year's insurance. So basing it off of these amounts that we already know, I'm going to take my annual taxes and I need to break those annual taxes down into monthly. So if you take your annual taxes and divide by 12, you get monthly taxes. And in this case, the lender wants to collect 4 months. So we'll have a debit that we'll see in just a second for $870 for taxes. And then we're going to go through that same little exercise. Annual homeowners insurance divided by 12 to get monthly. And in this case, they want to collect 2 months. So we're going to see 2 debits to the buyer for this escrow charge. There's going to be $870 for escrow taxes, and there's going to be $75 for escrow insurance. Again, we're just originating your escrow account, and we're putting some money in there as a cushion. Your first payment isn't due until January 1st. Taxes have already been paid, so the lender doesn't have to worry about taxes this year, but they want to have some money to start worrying about taxes next year. Again, sometimes those bills go up, so the lender wants to make sure that they have that to continue to pay those bills on your behalf. Questions? Questions on anything so far? Yeah.
On mine, it has 261, but we used 2,610. Is that still correct?
The 2610 is the annual taxes. The 261 is
okay.
Is what the buyer owes. Yep, you're good. Yep, what the buyer owes. Yep.
Seeing that dual number kind of.
Yeah, I see what you say now. That's an odd one. It doesn't work out that easy. Thank you for that. Yep. So what we're looking at is annual taxes and annual homeowners insurance. Okay. So let's just pause for a second. Let's recap what the heck we just did. We went through the problem and we identified, is this a credit to the buyer or is this a debit to the buyer? That's all we did. We did a little math, proration and interim interest. Again, possible standalone, standalone. Question comes in about the deed preparation fee. Why is that not on here? Because the seller pays that, not the buyer. And we're focusing on how much does the buyer have to bring to closing. I'll say it again. I probably need to say it 20 more times. Pages 561 and 562. That's the key. So now what we need to do is add up all of the buyer's debits and add up all of their credits. So I'll give you guys just a few minutes to add. Add up all their debits and all their credits. Yeah.
No, I was asking because wouldn't you want to add that to the credit side? $65?
Add what? I'm sorry.
The deed preparation.
Because deed preparation is a debit to the seller.
Okay, so it's basically invisible. It wouldn't go on the buyer credit side.
That's your distractor.
Got it. Okay, thank you.
Because all we care about with this problem is how much does the buyer have to bring to closing. We're just focusing on the buyer's debits and credits. Yep. So again, right now, we're just adding up all your buyer's debits and all their credits. And you don't have to tell me this in a chat. I'll have you guys answer me in chat in just a second. So on your paper, sorry, I didn't get to you fast enough. On your paper, adding up all the credits and all the debits. So what do we get? We added up all of our debits and we got 219,869.21. We add up all the credits. So what I want you guys to tell me in a chat, debits minus credits, debits minus credits tells us how much our buyer has to bring to closing. Debits minus credits. Thank you for the explanation point. Be confident about your answer. So 219, 869 and 21 cents. Debits minus 179,750 tells us to the penny, your buyer needs to bring $40,119.21. You've reviewed it. You're going to contact your buyer. You're going to say, you know, like tomorrow or the next day is settlement. We're that close. You're going to say, I need you to go to your bank. You've already had this conversation with them, you guys. Now that we're here, you're going to say, I need you to go to your bank and get a cashier's check or order a wire transfer to the attorney for $40,119.21. Readily available funds. Y'all, they cannot bring a personal check to closing. Nobody wants to wait 5 business days between settlement and closing for that check to clear, right? This is why we say readily available funds. Which do you do? Cashier's check or wire transfer? The attorney may have a preference. Some attorneys say we only take wire transfer. Some say they have their difference. So if you've never used this attorney before, you just call them and you say, we're getting ready for closing later this week. How would you like my buyer to bring their funds to closing? And the attorney will let you know. These things take practice. These things take time. I fear sometimes you guys chuck your pencil down because you don't know how to do it. Well, guess what? You just met this like an hour ago. Be kind to yourself. My goodness, you know, I promise you, the more you do, the more you practice, and the more you understand what's a debit to one party and a credit to the other, the easier these things will get. All of this work is for one test question, 1 point. But I hope you see the value in assisting your buyer, particularly, and helping them figure their numbers out. You may see some practice seller questions in your book and Learn Test Pass. How much does the seller get from closing? I don't think it's bad to work those because that helps you see debits and credits to the seller. Again, the buyer has more debits. So if I were you, I would really focus on the seller debits and know that everything else is a debit to the buyer. My exam is 4 hours, 112 questions, 4 hours. All the math is going to take you the longest. So I always suggest you always save the math for the end. And of the math, save this one for the very, very end. Help you to strategize a little bit so you don't run out of time. Y'all, if you don't answer something, then you don't get credit for it. It's an automatic wrong. So save the math for the end. And of the math, Save this one to the end. Remember, the math alone can't fail you. Questions, comments, or concerns? Let's do this. What we got? Will it ever ask about the recordation fee, like the deed recording and the deed of trust? This? Possibly. I'm surprised there's not a deed of trust recording fee on here, but again, we just do what the problem tells us. So there is no deed of trust. Does the lender want their deed recorded, their deed of trust recorded? Of course they do, but I can only work with what I got. So that's a great point. Thank you. Y'all don't ever go off problem because you know. Always and only do what the problem gives you. Fair enough? Okay. Well, that gets us through Unit 21. As far as I'm concerned, you guys, this is the end of the tough math. I did not say we were done with math. Let's make sure everybody heard what I just said. I did not say we were done with math. We're through with the big math. I still have a little bit more math. Look at y'all smiling. My God, I just made y'all's day, didn't I? Like, yeah, I hear you. I hear you. So we're through the big math. We still got a little bit more to do. I want to, let's see. Point something. I got a present for you guys. You guys want a present? Yeah. In Learn Test Pass, under the Unit 21 material, I have a math workbook. And the math workbook gives you additional math with explanations. So here's an extra explanation on tax calculations with extra practice problems. I know some of you have been through all the practice problems in your book and Learn Test Pass. And, you know, when you see a problem enough times, you know the answer is C without ever finishing it. So this is new practice, new problems for you guys. There's taxes, there's area and volume. This is Unit 4 math. Here's extra practice for you guys. So see, it gives you the little section and then breaks it down. Excise tax that we talked about in Unit 5. I have it. Here's closing statement, what we just did with some extra mini CD problems. Again, we haven't been through everything yet. So as you guys are working this math workbook, if you see, we've done commission, here's some extra commission math. I know I'm going through it fast. Net to seller, that was Unit 8. So this math that we've already done is extra. Profit and loss, we haven't done that yet. So don't worry about this yet, right? Just kind of focus on what we've done and know that when we do profit and loss, you have some extra problems here. Also with the math workbook is the solutions. So everything's worked out, the practice problems, the exams. So for those of you thinking, gee, Julie, that's not a very good gift. What's the present here? The actual present in the math workbook, other than extra practice, which you guys know by now how I feel about practice. If you don't do anything else with this math workbook, look at page 1. The first section tells you the math that you can expect to see on your state exam. Everybody see that? PSI is your state exam. The second section tells you the math that you can expect to see on my exam. You're not going to see all the math on my exam that you may see on your state exam. So let me help you in your study time as you're getting ready for our exam in 16 days. The second piece of page 1 tells you the math that you can expect to see on my exam. My suggestion to you to help with your study time is focus on this math for now. And then once you get through my class and you're ready to go to PSI, come back up and focus on this math. That is the present. Is that a good gift? That's the present. So page 1 of the math workbook, and not only does it have extra practice, explanations, all that other good stuff, questions? You're welcome. I need to stop sharing just for 1 second, so bear with me. And while I'm pulling up the next, I do want to say something really quick about our end of class exam. I am not talking about our end of class exam right now. We'll go over rules and expectations for our end of class exam. The very last thing we do together, that class before, we'll go over the rules and expectations. What I do want to say now, though, is for our end of class exam, you guys are all going to be on Zoom. You're going to log on every day like you always have. For our exam, though, you guys, I need you to be in a distraction-free zone. I do not tolerate any distractions during your final exam. If you're in a place in your home right now with a high traffic area and you have people walking by, particularly talking to you, I need you to start securing and finding a distraction-free place right now. Think about where you can go that you can be left alone. Here's the deal. If I see you talking to somebody in your room while you're taking this exam, I can only assume that you're talking to them about the exam. And if I see you talking about the exam, you're cheating, and the real estate commission says if I suspect you of cheating, I am to take your exam right there on the spot, no questions asked. Start now finding a quiet place that you can be left alone for 4 hours to take your exam. Fair enough? Everybody good with me on that? Again, we'll talk about rules and expectations and all that good stuff later, but I know some of you got a lot going on in your house. I know some of you got busy going on in your home. And that's why I want to make sure we're all on that page now to give you time to secure that distraction free. Zero distractions for the test. And I find animals distracting. You know, you guys always come in and say, I got to take my dog out. Well, now you've just distracted yourself. So if you can find somebody to care for your animal, that would be my preference. You know, kids, the same thing. I mean, when I say zero distractions, I've had students take their dogs to doggy daycare or whatever for test day, spa day or whatever, just to get them out of the house so they're not distracted. Questions, comments? All right, big deep breath. Ready? In through the nose, out through the mouth. Unit 17, rocking and rolling. Here we go. Unit 17 is our appraisers unit. To get through this unit, I think the best thing we can do is put on our appraiser hat. Did y'all know you got to wear an appraiser hat? I'm not kidding when I say a good chunk of this class is teaching you guys just enough to be dangerous. Guys, we're not an appraisal school. If you're interested in being an appraiser, you go to Google and look it up. And there's a class and a test and all that good stuff. We're not here to be appraisers. We're here to have a basic understanding of how appraisers work and what they do, so we can have these conversations with our buyers and sellers. We are going to talk a little bit about the agent, so we're going to take our hat off and on in this unit, but the main focus is through the eyes of the appraiser. So unit 17 starts on page 433. And this is our appraisers unit. And we're going to define various definitions of value. We're going to define value in various definitions. The start of this unit, there are 3 steps that the appraiser takes to find value. So we're going to look at the 3 steps, the 3 approaches that the appraiser can take. And as I said, we're not done with math. We're done with the big math, but there is a little bit of math, and we're going to talk about how to calculate those approaches of value. So first off, Appraiser 101. What the heck is an appraisal? An appraisal, the straight up definition of an appraisal is an estimate or opinion of value completed by a licensed appraiser of a specific property as of a specific date. Let's break this down. An appraisal is an estimate or opinion. Could a different appraiser have a different opinion? Could you have 3 appraisals with 3 different opinions? Yeah, it's one person's opinion. It's one person's estimate. We're going to learn in just a minute. The appraiser does not determine value. The appraiser gives their opinion of value. The buyer determines the value. The buyer is the one that decides that it's worth buying this house for X amount. So it's an estimate or an opinion of value. An appraisal is completed by a licensed appraiser. Again, separate school, licensing board, all that. It's of a specific property. The appraiser is only studying one property. For example, 123 Main Street. They're only studying that one property to get their opinion of value for 123 Main Street. And an appraisal is as of a specific date. Most lenders will allow you to use an appraisal up to 6 months, but it's very specific to today. We'll talk about why in just a second. Appraisers are always charged they always are paid a fee. They're not going to be paid a percentage of appraised value. The shady appraisers would increase their value to increase their percentage. Does that make sense? So they're always going to charge a flat fee. As we mentioned earlier, the appraiser is not going to go out and do their thing until they've been paid. So the appraisal is one of those POC things the buyer's going to have to pay outside of closing. The lender will communicate with the buyer about how that's paid. The appraisal is the property of the lender. The lender uses the appraisal to determine their loan to value ratio. Remember, we talked about the loan to value ratio, and value is the sales price or the appraised amount, whichever is less. So for the lender to identify how they originate their loan, do I do it on sales price or do they require the appraisal? The lender orders it, the buyer gets to pay for it. But the appraisal is the property of the lender, so they can determine if they're going to originate your loan based off of value or the appraised amount. Take your appraiser hat off for a second. What we have to do in this unit, we do something called a CMA or a BPO, which we will talk more about. We're just introducing it to you. So we're either going to do a CMA or a BPO as the broker. I cannot determine value. I cannot give my opinion of value. That's the appraiser's job. I need you guys as future brokers to take the word value out of your vocabulary. What we do on a much smaller scale with CMAs and BPOs is determine probable sales price or probable lease price. When your seller, when you're at that listing appointment and that seller looks at you and says, how much do you think my home can sell for? You need to be very careful how you answer that. If you say your home is valued at X amount, you just acted like an appraiser and you went out of your lane. Your response is, based on my CMA, your probable sales price is, when we have that discussion, I'll be very, 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 very careful. So we determine probable sales price or probable lease price. BPOs are typically done for a third party. And you guys, as future provisional brokers, cannot charge a fee You can do a BPO, but you cannot do it for a fee. Typically, the BPO, I said, is for a third party. A couple examples of this. I used to work for a real estate firm that had a relocation company. And that relocation company was headquartered out of like Connecticut somewhere. Those guys up in Connecticut have no idea what Winston-Salem looked like. So they would hire us to do a BPO on occasion to help them get this idea of value for a property that they're getting ready to either help their relocation client buy or sell. I'm not doing it to get the listing. I'm not doing it to help the buyer. I'm doing it for the third party relocation company. And as a full broker, I can charge a fee. Provisional brokers cannot. CMAs are traditionally done as part of our brokerage services. When the seller asks you, how much should we list my house for? You're going to do a CMA to help them determine probable sales price. When a buyer asks you, how much should I offer? We're going to do a CMA to help them determine probable sales price. Nobody, I don't care who you are, provisional broker, broker in charge, nobody can charge a fee for doing a CMA. In other words, when your buyer says, this is my dream home, how much should I offer? What you cannot say is, write me a check for $250 and I'll let you know. We cannot charge a fee for doing our job. So historically, the BPO is done for a fee. Today, we kind of use them interchangeably. But historically, the BPO was typically done for a third party for a fee. The CMA is just part of our job. The other example I have of BPO, this actually just came up in a post-licensing class earlier this year. One of my girls told me that the full broker that she shadowed, that she was mentoring with, got a call from a divorce attorney. And the divorce attorney was trying to settle the divorce and the assets. And one of the things was the home. So he called about 2 or 3 different agents and paid them to do a BPO for their opinion so that could help him with the divorce decree. So third party, you have no chance of getting that listing. You're hired to do that and just that. Again, we'll see these again. We'll talk more about these. And the last thing we do in this unit is going to be talk about our responsibility as agents when it comes to doing CMAs and BPOs. Questions so far? The appraiser gets to use the word value. You and I do not. Okay. So let's talk about this word value. In order to have value, you have to have dust. One thing that the appraiser is looking for with dust or with value is dust. They're trying to find the relationship between the desired item and the potential buyer. What do they think, in their opinion, a buyer will willing to pay for this property? And one thing that the appraiser looks at is demand. Is there a demand for the property? As demand adjusts, so does value. If you've been following this current housing market, right now, you know values are way up there, way up there. Why? Because demand has been so dang high for the last 2 or 3 years. Buyers drove up value. Their demand drove up value. And the appraiser needs to take that into consideration when they're trying to give their opinion of value. The appraiser is going to look at the utility. How does this property satisfy future owners' needs and desires? When something's custom built, who is that custom built for? It's custom built for you, isn't it? Is that custom built going to fix the next owner and the owner after that? And well, maybe it will, and maybe it don't. I don't know. But custom built tends to be for an individual. Is that going to make it valuable to the next buyer? I don't know. Maybe it will, maybe it won't. When I hear sellers go around their house talking about custom built this and custom built that, you know what I hear? Cha-ching, 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 cha-ching. Every time they say custom built, I figure we're tacking on to that purchase price That's the utility. How is it going to work? How is it going to fit for the next owner? Scarcity, how scarce is the land, the property? I mean, there's only so much land to go around. This is part of the reason why waterfront property tends to be a little bit more expensive, because it's scarce. There's only so many homes you can build up and down the East Coast. There's only so many homes you can put around Ballew's Lake. And then transferability, how easily can we transfer that ownership? Do we have clear title? Do we have satisfactory property conditions? What's the ease of transferring it? So the appraiser takes dust into consideration when offering their opinion of value. Market value is the most probable price a property will bring in this market. Market adjusts. Real estate is no different. Real estate is a market. And that market, that pendulum is constantly swinging. Buyer's market, seller's market, buyer's market, seller's market. This thing is constantly swinging. A year ago, we were like way up here somewhere in a seller's market. Now we're starting to see it adjust. We're not in a buyer's market yet, but as that adjusts, it's going to affect market value. So the appraiser is looking for the most probable. Guys, this is no guarantee that this is what a buyer is willing to pay for it. The buyer is a customer buying a product. It doesn't matter if you're talking about a sweater or a house. The buyer is a customer buying a product. When you go shopping and you're in the rack of sweaters and you're flipping through and you pick up a really nice sweater and you say, wow, I really like that. And then you look at the price tag and you see that that sweater, that's more than what you would ever pay for a sweater in your entire life. What do you do to that sweater? You gently put it back so you don't snag it, right? Gently put it back on the rack and walk away, right? Same thing with buyers. If they don't see the value in the home, then they're not going to pay that price. That's why they are the ones that actually determine value. The appraiser gives their opinion. The buyers are the ones that are deciding whether or not they're actually going to pay that price. So let's do a little side-by-side comparison here. Market value is referred to as the appraisal process. The opinion of value. Market price is what somebody was actually willing to pay for it. The appraiser offers their opinion. The buyer determines if it's worth them paying that or not. Another thing that I think is important that we make sure we understand, I think this affects sellers, listing agents more than anything, is market value versus market cost. Market value is still the appraisal process. Market cost is past expenditures. Occasionally, sellers feel that when they invest in the home and the property, they can expect 100% return. And it doesn't always work that way. I've always heard, I've never had the chance to experience, but I've always heard the very first time you drive a brand new car off the lot, it already starts losing value. You cannot drive that car for 2 months and then take it back and expect to get 100% return, can you? As soon as it hits the street, it started to lose value. And same thing. Do your head one way or another. Is a brand new roof more valuable than a 20-year-old roof? A brand new roof more valuable than? Absolutely. Can you get 100% return on a brand new roof? No. And that's what we mean by market cost. Just because you sink money into it doesn't mean you're going to get it back. Y'all, I had a listing appointment a couple years ago, and it was the sweetest couple. I really, really wanted to help them out. And this is before the crazy housing market crash. I might have been able to help them out later, but This is before the crazy, not market crash, but the crazy market that we're in right now coming out of. And I went to the listing appointment and I did my CMA before I went. I did my research and my homework. And at the listing appointment, it came down to, what do you think we can get? What do you think we can sell our house for? And I whipped out my CMA and I said, based on my research, I feel like your probable sales price, and I think I said like $95,000 to $100,000, somewhere in there. That couple shot each other a look that told me in one instant that we were not on the same page. And I said, what were you guys thinking? And they said 125,000. I'm at 95. They're at 125. Are we way off? We're way off. And I'm like, okay, it's not over yet. Hang on. Talk to me. How did you think 125,000? And at that time, he handed me a piece of paper. Water heater, X amount, roof, X amount, HVAC, X amount. They tallied up all the money they put into it and thought they were going to get. And I said, oh, thank you for sharing this piece of paper with me. Let me go back and crunch my numbers again. Let me go back and look at it. So I call my team leader, because sometimes two heads are better than one, right? I said, let's look at these numbers together. And she said, Jules, we might be able to get 107. We're going to sit on the market. It's going to take a special buyer to pay that. She said, but there's no way we can do 125. Guys, I ended up not taking that listing because I did not feel in my heart of hearts that I could get that seller what they wanted. Now, I'll also share this with you guys. I hate losing a listing for whatever reason. I hate losing a listing. And I will stalk that listing. I'm on MLS every day because I want to know who lists it. I want to know who got it and for how much. I watched that listing for months and nobody ever listed it. And that tells me that they had a different opinion of value based on their market cost, based on their past expenditures. Last year, I probably could have gotten them 107. Last year, I probably could have gotten them 145. Let's be honest here, because last year was a different market than whenever this was 3, 4, maybe even 5 years ago by now. I don't remember. It's important. Let me say this. Value is in the eye of the beholder. Sellers tend to come in with more value. Y'all, this is the seller's home. To everybody else in the world, this is just a house. So sellers tend to have more value, blood, sweat, and tears. Remember when little Johnny fell over there and scraped his knees? There's memories, there's things that they can attach to. Is this making sense? So it's important. This is why we understand sellers aren't the ones determining value. Appraisers aren't even determining value. It's the buyer that's determining how much they're willing to pay for that property. Samantha, did I see your hand a few minutes ago?
No, I was just clapping for you for not taking the listing.
Y'all, they were the sweetest couple I've ever met. And I really, really, really wanted to help them out. But you got to think, is it worth your gas to drive to this property? Is it worth your marketing dollars, your advertising dollars? I mean, maybe you would have taken it. I didn't want to set them up for that because I didn't feel anything I had in me. I don't know much about life, but I know numbers don't lie. And when you got the numbers right in front of you, that's what we have. And that's what we do CMAs for. We'll talk about in just a second. Questions? Okay. So back to appraiser hat back on. Put your appraiser hat back on. Let's talk more about value. And the appraiser will look at things that influence value. Social forces affect value. Our trends in marriage and divorce rate, family size, how long we're living, all that is constantly changing. We're now going through, we're seeing multiple family units under one roof. Maybe the kids are moving back home with mom and dad. Maybe mom and dad are moving in with the kids. We're seeing new dynamics under one roof. And those social trends through the eyes of the appraiser, affect value. Economic forces, economic trends affect value, employment levels, unemployment levels, property taxes. The biggest thing we just went through is current interest rates. Why was demand so high last year? Because interest rates were like 2 point something, 3 point something. Buyers were coming from everywhere to buy. The problem is we didn't have enough sellers willing to sell. They created the interest rates, or what helped create demand. Political forces, various government activities like zoning changes, for example, building codes. Let's see, I've been in this 21 years. So how many presidential elections have I been through since I've been in real estate? I'll let you do that math. And one thing I've noticed, when it's the year of a presidential election, real estate takes a slight pause until after the election, because everybody wants to know the outcome of that election to know if they want to spend their money or not. And when the parties change sides, the other side comes out of the woodwork. It's affected by political forces. And then there's environmental conditions, physical forces, location, location, location. Don't we know that is the three most important things about real estate? Proximity to jobs, amenities, topography. Topography is the lay of the land. How hilly is it? How woody is it? How usable is it? All of that affects the appraiser in trying to determine that value. And I think before we flip the slide, I think we're going to go ahead and take a break, just so I don't start something and then have to stop in like 3 minutes. So I know we're a little early, but let's go ahead and take our break. When we come back, we'll keep talking about value. All right. How we doing? Good, good, good. Sometimes I get calls from you guys after this unit. How do I become an appraiser? So first off, please one thing at a time. Don't try to do both. I can't imagine. My little brain can't handle all that. But second off, Google North Carolina appraisal license. Everything you need to know once you get your real estate license. Fair enough? It's interesting. It's interesting. And I tell you guys, the appraisers will tell you that they're aging out. They need kind of some young blood in. So if it's something you're considering, this might be a great time to get in. All right, let me take attendance. Cameras are on. So starting on page 437, we're just going to define some appraiser terms, some appraiser words that help them determine that principle of value. The first term we have, and probably the most beneficial of the appraiser, is the highest and best use. You guys remember way back in Unit 1? Didn't that seem like a long time ago? Way back in Unit 1, we introduced you to the idea of highest and best use, but now we're going to get into it just a little bit further. Highest and best use tells the appraiser what the most profitable use for the property is now. The appraiser is not telling the homeowner how to use the property. The appraiser is determining what's the most profitable use for the property at this moment. Highest and best use can and does change. As cities grow, as we face decline, you may have expanding areas. It might be that something that was once now farmland and was zoned for agricultural is now a retail center, for example, a shopping center or something. Highest and best use can and does change, but I think what we need to understand is that there can only be one highest and best use at a time. So again, the appraiser is always going to look at this and ask themselves, what is the most profitable use of this property, and is it being used for that most profitable use? That's how you get value. Substitution. The theory behind substitution says that when a consumer has essentially two items, similar amenities, similar features, the consumer is generally going to choose the cheaper of the two, the less expensive of the two. Again, similar features, similar amenities. With substitution, think like comparison shopping. If you're going to pay more, you expect more things. You expect more quality, maybe, for example. So the consumer's they're gonna comparison shop. And they're going to substitute, in general, substitute the less expensive one for the more expensive one. Supply and demand, economics 101. When supply goes up, demand goes down. When demand goes up, supply goes down. That's what we need to know about economics. You know, in real estate, we don't sit around. You're not going to hear a bunch of agents sitting around chit-chatting about supply and demand. What we talk about in real estate is a buyer's market and a seller's market. We're coming out of a seller's market. Why was it a seller's market? Because supply was low and demand was high. Demand was very, very high, supply is low. As that pendulum shifting, we're going to start seeing supply go up and demand come down. I'm on page 437. The idea behind conformity says that the property's maximum value is reached when it matches its surroundings. If something conforms, the appraiser tends to put more value on it. Have you guys ever been out for a lovely Sunday afternoon drive and you're on like this 2-lane road in the middle of nowhere? You really don't know where you are. Country road, and you're out and you see like single ranch after single ranch after single ranch. You're meandering along. And all of a sudden you round a corner and bam, there's this monstrosity up on the hill with like 2 stories, brick, 3 garages, a gate, possibly a pool. That thing doesn't conform. It doesn't match its surroundings. Please do not misunderstand. I did not say it doesn't have value. I said it doesn't conform. It doesn't match its surroundings. Anticipation, some future benefit or detriment can affect value. Maybe it's the truth. Maybe it's based off of rumor, false information. But the anticipation of something coming or going from an area can affect the value. Where are my Kernersville people? Where are my K Vegas people? How long have they been talking about that daggum belt loop? How long did they talk about that thing before they actually built it? That was the anticipation. The anticipation of that thing coming helped drive those property values. People were hesitant to buy because they didn't know if they were going to lose part of their property to that new belt loop. Just the idea of it coming affected the value in properties in that area. Contribution is what the improvement to the property, how it adds value. When you contribute something, how does it add value? Getting back to our whole, you're not going to get 100% return. I'm all about homeowners doing whatever they want to with their property. I'm all about it. It's your home. Go nuts. Do what you want to do. But understand what you do today may not contribute to the value when you turn around to sell it. Not all neighborhoods, for example, will support granite countertops. If you want granite countertops, I say go get them. Just understand that it may not contribute to the value. When we talk about competition, or when the appraiser talks about competition, think of retail. And the idea of competition is that stores attract people. What's your favorite retail shopping center? If you're in Winston, I always tend to think of Thruway Shopping Center. And what does Thruway want? If you go to Moe's for lunch today, doesn't Thruway after lunch want you to stick around and go to Rack Room Shoes and go to the little kitchen gadget store and go by Dewey's and get your pink lemonade cake square, right? That's the idea of competition. What got you to Thruway? Hopefully the competition will keep you at Thruway. The longer you stay at Thruway, the more money you spend. And then change affects the value. One thing the appraiser does is try to anticipate change. Are there zoning amendments on the table? How is that change going to affect the value? Is there a beltway coming to the area? How that change? So they use that information to help better predict the value of the future. So again, just some appraiser terms, basic understanding. And then on 438, I don't know why my numbers aren't showing up. Sometimes I do, sometimes I don't. But we're on page 438. And with the appraisal process, the appraiser tends to look at 2 different classes of data. Specific data is data that they gather that's specific to that property. 123 Main Street. What are the features? What are the characteristics? What are the things that add value to 123 Main Street? General data is details about the neighborhood, the surrounding area, the community. So the appraiser not only studies the individual property, but they also study the area around to see how it conforms to the neighborhood. Is that political? Not sure what that is. And your camera's not on. Are you here? You're having problems today. That's right, I forgot. So specific data is about the property itself. General data is about the neighborhood, the area, the community, the subdivision, etc. So pages 438 to 439 talks about the steps that the appraiser takes. Now, I don't want you guys spending all your time studying this, But I do think it's a good idea to look this over and just kind of get an idea for what the appraiser does. Again, it's about giving ourselves a little bit of knowledge so we can help explain this process to our buyers and sellers. So the appraisal process, and if you guys will flip with me, let's look on page 441. Once the appraiser arrives at their opinion of value, they send an appraisal. An appraisal is what we're looking at on 441. And I apologize for not telling you guys to bring your magnifying glass to class today. So I'm not sure how well you can see that or not, but there it is. And you can see, you guys see the little black line that runs down the left-hand side? There's different sections. There's different categories in that little black line. So there's the subject property. That's the property that we're studying. The contract information, what do the buyer and seller agree to? There's the information about the neighborhood, about the site, how big is the land, the topography, the lay of the land, and then the improvements on the property, the structure, the fence, the storage building, etc. Sidewalks, for example. Over on page 442, we continue our appraisal. And that first big section there is something called the sales comparison approach that we are getting ready to talk about. The appraiser can use this information. They can study recently sold comps nearby to help them determine the value of the subject property. Their reconciliation, their findings are down at the bottom of 442. And then over on 433 is some other, what's that say, additional comments. And then the cost approach, which we're getting ready to talk about, income, etc. So this is just a sample appraisal. We'll see this again when we're done. I think a lot of this will make a lot more sense once we're done. But if you're having a hard time reading the appraisal itself, if you will go back to page 440. You guys see the bullet points on 440, subject, neighborhood, site. Those are the different sections, the different categories on the appraisal. So if you couldn't see what we just looked at on 441, then you have that information there on 440. So what we're going to do now is talk about the approaches to value that the appraiser can take. And there's 3 approaches that they may take, that they have the option to take. And the appraiser is going to do as many of these approaches as they can to help them determine their opinion of value. So over on page 444, we start with something called the sales comparison approach. The sales comparison approach, also known as the market data approach. What this approach does, the appraiser studies the subject property. The subject property is the one that they're trying to give their opinion on value. So they study the subject property and some of the features of the subject property that we'll talk about in just a second. And then they go out and they look for recently sold comps nearby. They're looking for things that are similar to the subject property as possible. Because if they study what a buyer was willing to pay for the house next door, that helps them better determine their opinion of value for the subject property. So they study the subject, learn all about the subject, and then go out and find these recently sold comps for them to determine a buyer is willing to pay this for it. So we need to make some adjustments so we can see what my opinion of value is on the subject property. The sales comparison approach is best for resale single family homes, resale, and land. So when the appraiser is trying to offer their opinion, and they use the sales comparison approach, they're going to put the most weight on properties that are resale single family or land. Again, how do they come to their opinion of value using the sales comparison approach? They compare it to recently sold homes nearby. They're comparing. When the appraiser is making adjustments, the adjustments are going to be made to the comps only. They never ever adjust the subject. The subject is the one that they're trying to get all the comps to match. Let's see, so do they compare more of the subject property features to recently sold properties or properties that have just recently sold in the same location? We want nearby, absolutely, we want properties nearby, because what's the three most important things about real estate? Location, location, location. You can move a house from one end of town to the other or one county to the other, and you're going to change the value just because you've changed the location. So what we want is nearby, you know, close as we can. And we want things that have recently sold, because that tells us what a buyer was willing to pay for it 2 weeks ago or 3 months ago, for example. So they look at it all. They got to study it all. So what are some things that the appraiser studies with the sales comparison approach? Again, the date of the sale, we want things that are recently sold. In general, the appraiser tries to stick with things that close, comps that closed 6 months ago. However, if we haven't had a lot of closings, then we may have to go back later than 6 months. But 6 months tends to be the sweet spot, what we shoot for. Location. You don't want to go look at it, compare a home across town, or compare a home even, you know, couple miles away. I think how far out of location it goes, the appraiser goes, depends on density. If you're downtown, you may not have to go out as far. You may, you know, quarter-mile radius search, for example. If you're out in the middle of nowhere, you may have to go out a little further to find recently sold comps. The appraiser, again, also studies the physical features of the subject. What's the square footage? What's the lot size? How many bedrooms? How many baths? Is there a fireplace? Is there a garage? Physical features that make the subject property. And the comps that they're looking for are going to have similar features. Please understand, no two homes, no two properties are exactly the same. You're not going to find an exact match. The appraiser is not going to find an exact match. So this is why we need properties with similar adjustments or similar features. The fewer adjustments the appraiser has to take, the more accurate their sales comparison approach is going to be. And then they look at terms and conditions of the sale. Did the comp was the comp a foreclosure, for example? And if the comp was a foreclosure, are foreclosures common right now? Are they popular right now? I know we talked about the housing market crash, and every other home, maybe not, but seemed like it, was a foreclosure or short sale. So the appraiser had to take those during that time into consideration, because that was the norm. That was what the market was dictating. So terms and conditions of the sale, foreclosure, short sales, for example. When the appraiser is selecting comps, they're looking for something as similar to the subject as possible. Do your head one way or another. Is it fair to compare a second-story condo to a two-story brick ranch? Is that a fair comparison? No. So we're looking for as similar to the subject as we can. Condo for condo, brick two-story for brick two. You guys with me? Townhome to townhome. We want similar to the subject as possible. Abby, I'll get that in just 1 second. Again, things that are recently sold, we want recently sold comps. This tells the appraiser, this is what a buyer was willing to pay for this comp property 3 months ago. The appraiser gets to assign dollar values for the differences. The appraiser understands what the value of a fireplace in this neighborhood is. The appraiser understands what the value of square footage in bedrooms, etc. You and I don't know value. So when you see a sales comparison approach problem on your test, it'll have to give you value. I do not want you guys to stress out about finding value. If you want to stress out about finding value, go to appraiser school. That's how you learn all about value. Fair enough? So if the problem wants you to adjust it by a bedroom, it's got to tell you the cost of that bedroom. And then they use a simple correlation. It's not a weighted average. Some comps are better than others, so they're going to have a higher weight. If you have a comp that isn't as great, then you may not want to put as much weight, as much consideration into that. Again, the fewer adjustments that the appraiser makes, the better they are getting determining value for the subject property. So, say a two-story subject is located near a recently sold property that's a ranch, but there's more similar property to the subject property further away. Would you still choose to compare the ranch that is closer in location rather than the house that further that same similar feature? Would you be mad at me if I said the answer to that is it depends? Because now it's going to depend on the location, the features. I'm not saying you can't study that ranch, but before you study that ranch, let's see if there's something close by that isn't better, right? You may have 20 homes close by that recently sold, but not all 20 are going to be good comps. And that right there is why the appraiser determines value. It's an opinion. I should say it's an opinion of value. 20 closed comps nearby. I picked 3. Could you pick 3 different comps to study? It's your opinion versus mine. Does that make sense? That's why it's an opinion, because there's no science to this is the comp that you have to use. It's this appraiser's opinion. And as we're going to see in just a minute, this is the basis of our CMA. The appraiser does the sales comparison approach. You and I do the CMA. So let's talk about these adjustments. It is so important that we understand that the subject property never, ever, 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 ever adjust. So let's pretend that this line I just drew is our subject property. If you have a comp that has a feature more than the subject property, you need to adjust the comp down to match the subject. Never ever adjust the subject. You always adjust the comp to match the subject. Similarly, if you have a comp that doesn't have as much of a feature, you adjust that comp up to match the subject. Never ever adjust the subject. Let's do a little thing together. You guys push back, give yourself some room. If you want to stand up, that's fine. Only if you're, decent from the waist down. But if nothing else, give yourself some room, push back a little bit. And I want you guys to take your left hand and make a fist and hold it straight out in front of you. This way you need some room here. Take your left hand, make a fist and hold it straight out in front of you. We're going to call your left hand the subject property. And we're going to see that the subject property never moves. Your hand is going to go to sleep by the time I'm done with you guys. Now take your right hand and make a fist and hold it straight up over your head. So let's say your right hand is a comp. The left hand is your subject, the right hand is a comp. If your subject has 3 bedrooms and your comp has 4, which one is higher? Which one has more? The comp, right? Subject has 3, comp has 4. How do you make your comp match your subject? What do you have to do to make your comp match your subject? you lower it. You have to decrease the comp by the cost of a bedroom. Does that make sense? Your subject has 3, your comp has 4. I got to make my comp match my subject. So how do I make it match? I deduct, I lower it. Now shake your right hand out, make a fist and hold it by your side. Now let's say your subject property has 3 bedrooms, but your comp has 2. Which one has more? Subject. How do you make your comp match your subject? You add a bedroom. Use the hand trick because it gets really confusing otherwise. It's going against the grain. So when we're studying these comps, when we're looking at these subject versus comps, the subject remains constant. It never changes. The comp either has something more than, in which we deduct, or it has something less than, in which we add. Either way, our goal, our mission is to make our comps match our subject. Questions so far? So nice compare and contrast. Again, the appraiser is the one that does the sales comparison approach for them to offer their opinion on value. You and I do a CMA or BPO. We do not get to offer our opinion on value. We get to offer our opinion on probable sales price or probable leasing price. The CMA is the closest thing that we have to the sales comparison approach. Again, it's so important that we understand. The appraiser does the sales comparison approach. You and I do the CMA. For your exam, you're going to be asked to do a sales comparison approach. But again, they will have to give you that value. Like I said, if you want to know to determine how much value to put on a fireplace at 123 Main Street, just go to appraisal school. Stay in your lane otherwise. Will you guys promise me this? If you don't get anything else from this class, stay in your lane and document everything. That's the two big takeaways there. So take your appraiser hat off. Let's think like a broker again. And let's talk a little bit more about this CMA. The CMA is the informal version of the sales comparison approach. It's similar. When we report probable sales price and probable lease price, we're going to report as a range. Do you guys remember my story earlier about that sweet couple that I wanted to help, but they had a different opinion of value than I did? And when they asked me what I thought I could sell their home for, I told them $95,000 to $100,000. I didn't give them $98,333, did I? I gave them a range. The appraiser is going to give the exact amount. We report our findings in our CMA as a range. When we're doing a CMA, particularly for a seller, when you're at a listing appointment and the seller wants to know what we're going to list their house for, on the CMA, in addition to studying things that recently closed, we're also going to refer to current listings, things that are currently for sale. Why would I care about that? Why do we care that there's a house a block and a half away for sale? Yeah. That's our competition, isn't it? To the sellers, it comes down to time versus money. So if they need to sell fast, we need to be competitive, don't we? If they don't want to be in a hurry, maybe we can go a little bit more. But studying what's current will help your sellers see this is who you're up against. If a buyer wants to buy in this neighborhood or this subdivision or this school district, this is what you're up against. Also, when working with sellers, we're going to study expired listings. Why is that important? Why do I care about expired? Yeah. I don't know why, but for whatever reason, at this list price, a buyer wasn't willing to pay that. So the home a block and a half away that never sold, it expired. Maybe it was overpriced. I don't know. I'm not going there. But what it helps us see is at this list price, a buyer was not willing to pay that. We were unable to form a contract. Back to my sellers. I really wish I had an expired property nearby, particularly one that was about 125, so I could show them a similar home in your neighborhood was listed for this and nobody was willing to pay that. Does that make sense? So when you and I are doing CMAs, we're studying the market. What did I tell you guys on day one? We're the experts of our market. We're the experts of our industry that we work. And a lot of that is being aware of what's active, what's under contract, what's expired. CMAs that we do for buyers and sellers need to be, well, for sellers particularly, they need to stay current throughout the listing. We're getting ready to get back into a time where homes are going to stay on the market longer than 12 hours. We're starting to see days on market come up a little bit. I'm actually following one in my neighborhood now. It's been on the market for 15 days. That's just unheard of, here recently. Back in the day, 15 days, we were just getting started, and that's the market that we're seeing ourselves adjust back to. That home that I'm also watching in my neighborhood has also had a price drop. So before we can have the discussion with our sellers about, if any, what price drop do we want, we need to produce a current CMA. Guys, remember, we're only going back like 6 months. So if the first time you did a CMA, you had a comp that closed 6 months ago, and then 1 month later you do a CMA, that comp is now 7 months and it's fallen off of your comps. And the one that closed last week is now added. Does that make sense? So we need to, if we're going to adjust, if we're going to re-talk figures, we need to make sure that we're keeping these things current. Are you guys going to keep copies of all of your CMAs in your transaction file? Are you? To your head. Are you? Yeah. Because what do we document? Everything. Guys, my firm is taking this a step further. We now have our sellers initial this sucker. So we can show them, hey, we sat down and discussed this with you. We had a conference. Does that make sense? Document everything, keep it current, keep it in that transaction file. CMAs are client level service. I'll only do a CMA for you if you hire me. If you don't hire me, you don't get a CMA. I can, as a customer, I can produce to you market data, kind of a whole conglomeration of this is what the market looks like, but I can't interpret it for you. So if you have a buyer or a seller on the fence about whether or not to hire you, this could make a big difference. CMA versus throwing a bunch of numbers at you and saying, there you go, figure it out. So what does the CMA and the BPO mean for us? Well, we're going to talk more about us at the end. But I think the thing to understand right now is that the Real Estate Commission will hold us accountable for not performing these things in a competent manner. You get this information that you need from whatever MLS you're a member of. When you join the Triad MLS, they have a nice little handy dandy feature in there. You select the properties and it does quick CMA and it generates this little report for you. Again, I'm not determining value, but I am comparing comps to the subject. And as we said, I may pick 3 comps, you may pick 3 different comps. Neither one of us are right or wrong, it's both of our opinion. As long as we're performing in a competent manner. The Real Estate Commission does not want us just going in there and throwing any old thing all out there. You will get a lot more training from your firm once you join. Hopefully your BIC or a seasoned agent will be sitting with you, going through CMAs, helping you pull them, helping you determine which comps are better than others. I know the Winston-Salem Board of Realtors, probably about once a quarter, does CMA training. That's part of the things you get with your membership dues. I hear agents cry all the time, why do we got to pay these fees? You get CMA classes once a quarter to start with. It's whether or not you're going to take advantage of it or not. I've done a couple of the CMA classes, not since COVID, but the last one I did, it was still in person, and they actually had an appraiser there offering the class. It was invaluable to hear his take and his information. So I guess my point to you is take advantage of the free training opportunities that you have with your local board. Okay. So appraiser hat back on. When the appraiser is determining value for your test, for the sales comparison approach, as we said, for the most part, they're going to have to tell you what that value is. I don't think you're going to see anything like this, but if they expect you to determine, for example, the value of a bedroom, then they're going to have to show you. Comp 1 has 3 bedrooms, it sold for $250,000. Comp 2 has 4 bedrooms, it sold for $254,500. Everything else is the same. The only adjustments to make are the number of bedrooms. So what is the value of a bedroom? Well, if we take the difference in the sales prices, we can learn that the value of a bedroom is $4,500. I don't think you'll see this as a math problem, but this may help us understand where we're getting to the value, how we're determining that. I would like you guys to look with me on page 446. 446. And what we have is our sample sales comparison approach to value. You see your subject property, it's 155 Potter Drive. And the appraiser has gone through and studied the subject. There's no financing concessions. It's in good location. It's 6 years old. Here's the size of the lot. It's a ranch, 6 rooms, 3 bedrooms, 1.5 baths, square footage, et cetera, et cetera, et cetera. That's what we mean by how they went through and studied the subject property. They looked at all the property features of this subject property. Now that we've studied the subject property, now we're going to find comps. This appraiser was a little over ambitious. They say if you can find 3 to 4, 3 at the minimum, but 3 to 4. So we got what, 5 here. Comp A, Comp B, Comp C, Comp D, and Comp E. We can see the sales price. That's what a buyer was willing to pay. $118,000 for A, $112,000 for B. And then they went through and made the adjustments. The appraiser determined, for example, that Comp B is in poorer location than the subject property. Subject's in good location, Comp B is in poor, which is less, the poor. So what do we do to make Comp B match the subject property? We add for that condition. You guys see what we're doing here? We adjusted the comp to match the subject. Did I adjust the subject ever? Never, ever. Always adjust the comp to match the subject. Condition, et cetera, et cetera. Then at the bottom, you have your net adjustments. What are the adjustments that we made? And then the appraiser offers an adjusted value. once we studied comp A as it relates to the subject, if comp A were the subject, it would not be 118,000. It would be 116,500. Everybody seeing that? That's that adjusted value down there at the bottom. We're adjusting the comp to match the subject. From there, the appraiser is going to study which one, A, B, C, D, or E, is the closest to the subject. The fewer adjustments, the better comparison you can make. So their opinion of value is going to be based off of their adjustments and which one they had to make the fewer adjustments on. And that, if we go back real quick to page 442, that's the sales comparison approach. You got your subject property, 123 Colorado Lane, and the comps, and then all the adjustments made to the comps to match the subject. And then at the very bottom of that little section, I need a light to see this, my goodness. At the very bottom, it says indicated value by sales comparison approach, $265,000. So what they did is they studied the comps, and based on that, they offered their opinion using this approach of 265. Now, keep in mind, this is only one approach to value that the appraiser can take. So we're not done with our approaches of value, but this is simply one form that the appraisal can take. Appraiser. Questions? So what we're going to do, I have a sales comparison approach for us to work, but I only got 15 minutes left and I don't want to start something I can't finish. And we've already done one math today. So if it's okay with you guys, we're going to skip this. We're going to do it first thing on Thursday. Okay, so this will give us a good opportunity to review the sales comparison approach. And then that way we don't have to break it up and try to get caught up. Is everybody good with that? Thumbs up. I just made an executive decision like 2.5 minutes ago. So we will start with this on Thursday. We'll do a problem together. And there we go. Questions on the sales comparison approach so far?
I have a question, Julie.
Yeah, please.
When you're doing the sales comparison approach, do most real estate firms that you're working with already have this template and you just fill in the blanks, or do you have to create one on your own?
Well, so the appraiser is doing the sales comparison approach, and I don't know. I mean, this is like a standard appraisal.
I'm sorry. I meant for your
my CMA?
Yes, CMA.
I just clickety click in MLS, man. Click, 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 generate report. Poof.
Okay.
And then of course I study it and look at it right before I hand it to a seller, right? Don't just hit generate and say, here you go, right? Make sure you understand it as well. Yeah. But yeah, that's a good question. Thank you. No, we don't have to recreate the wheel. MLS does that for us. As far as the appraisers, you know, again, what we're looking at here is a pretty typical appraisal. Okay. So we're going to skip this for now. We'll see this on Thursday. Is that right? I'm still not back on my days yet, so kind of bear with me. So Thursday, we'll do this first thing on Thursday. The second approach, or another approach, I guess I should say, another approach that the appraiser may take to help offer their opinion on value is something called the cost approach. The cost approach is the best approach for special use properties. Examples of special use properties: schools, churches, libraries, hospitals. You may not have a recently sold church nearby that you can do to do the sales comparison approach. Another example of a special use properties that I know you need to know is new construction. if you're building a new construction subdivision amongst a neighborhood that was built in the 60s, is it fair to compare a home from the 60s to the home built in 2023? Have things changed since the 60s? Have building supplies changed? Have building codes changed? So because you may not have a new construction nearby, you may not have a recently sold new construction. One common way, until we can get some comps, one common way to put value on a new construction is the cost approach. And what the cost approach does, the appraiser will put the value on the land as if it were vacant. And then they put a value on the structure. So they separate the two. How much is this land worth if it were just land? And how much does this structure go for if it was just the building? So they separate the two. The appraiser, when putting value on the land, can most likely use a sales comparison approach if they have close comps, vacant land nearby. They may also use like a cost per square foot kind of formula. However, they can calculate that. The structure gets more complicated. The structure asks the question, if we were building this building today, what would it cost? So a couple things about the structure that the appraiser needs to consider. First off, are we going to build an exact duplicate at today's prices, an exact duplicate of today's prices? Or are we going to build something that's not an exact duplicate, but serves the same purpose? If we're building a new school today, I can promise you it has different features today that a school being built even 20 years ago doesn't have. Did schools 20 years ago have Wi-Fi? Did they have a computer room? I mean, I had a typewriter room, right, in my school, but things have changed. So one thing is an exact duplicate. Is it a historic building, for example, that we're trying to reproduce? Or is it a church for a church, but not the exact duplicate? Not the exact same church as what we've already built. So reproduction cost versus replacement cost. For the structure and possibly even the land, the appraiser may look at the square foot method. This is the most common. The square foot method just answers the question, how much does each square foot cost? So the cost per square foot, remember we looked at that back in Unit 4? Cost per square foot times the number of square feet. So if, for example, the whole cost of the structure is $250,000 per, and there's, I don't know, making numbers up, 1,500 square feet, what that tells us is that each square foot costs, that's not right, $167. That's what we're determining. How many square feet do you have and how much does each square foot cost? That's probably the most common way. And again, we can do this for land as well. Other methods, particularly for the structure, not as often used, might be a unit in place method. This is the cost per unit of measure. So the cost per unit of measure looks at material, labor, overhead, profit. And then the quantity survey looks at the raw materials that you need to build. If I were you guys, I would focus on cost per square foot. Most common, I think easiest to determine. Remember, we're trying to put a cost on the structure. How much is the structure worth? Also with the structure, one thing that the appraiser needs to take into consideration is depreciation. Depreciation is the loss in value for any reason. Maybe it's wear and tear, maybe it's age. All structures depreciate. For our purposes, for your exam, land never depreciates. Structures come and go, but the land remains. So when we talk about depreciation, we are talking about the structure. And as that structure loses value, the appraiser needs to take that in consideration. And there are a couple different types of depreciation. We're going to look at each of these. I've not been doing good about, can you guys see my page numbers again? Did they pop back up or? No, I'm sorry, 449. Sometimes they work, sometimes they don't. I don't pretend like I understand Zoom. So on page 449, we look at different types of depreciation. First off, we have physical deterioration. Physical deterioration can be curable, it can be incurable. Curable physical deterioration is just wear and tear. Things that are physically and economically feasible to do. Painting a house is curable physical deterioration. Or not painting. You can lose value by not painting. Just physical wear and tear. It's curable. It can be taken care of. Incurable physical deterioration, things that may not be economically feasible. When you fix the structure, the foundation, for example, it may not be worth the value of the home. Is it economically feasible? By the way, I feel the need to say that I'm not a structural engineer. I'm not telling you that there's a structural problem. If I were an agent and saw this, I would have a red flag go up and encourage my buyer or seller to talk to a structural engineer. That's my disclaimer. My flag just went up. Structural problems aren't cheap, typically. It may not be economically feasible. So there's physical deterioration. There's also functional obsoletes, things that are obsolete. Functional obsoletes, again, is curable and non-curable. Curable functional obsoletes are outdated designs, things that are no longer common, popular in trends. My bedroom growing up had blue shag carpet, and I wish it looked as pretty as what this does right here that you were looking at. That's a curable functional obsolete. Can we replace that shag carpet? I've lived in some lovely places. My first apartment in High Point, the entire kitchen, everything, counters, floor, refrigerator was avocado green. Is that curable? Is that for some? It was popular once upon a time ago, but it's out of date. I hope these things have been updated since I've left. That's curable functional obsoletes. It's an outdated design, but it can be easily cured. Incurable then are things that can't be easily cured. Again, it's not financially or economically feasible. This is a cute little house, yes? What's wrong with this house? Well, nothing. I guess it depends on the buyer. This house was built in 1920. Obviously, it's had some updates and some upgrades in the last 100 years. 100 years ago when we were building houses, y'all know how many bathrooms we had in our houses 100 years ago? Just one. Today, don't we all like our own bathroom? So something like that, this was a 4-bed, 1-bath home. It may not be physically or economically feasible to update it. Central AC, not all homes have central AC. And it may be that it's not curable, it's incurable to update it. I hate to leave you guys with this, but here we are. The third type of deterioration or depreciation that we have, excuse me, is economic obsolescence. It's always incurable. Economic is always incurable. It's your outside factors, your outside forces. What you guys are looking at here, my Winston-Salem people, you go down Griffith Road, you go behind Village Tavern. We all know where I'm at. You go behind and you keep going. And eventually Griffith Road dead ends into Clemensville Road, right? Y'all know what's on the corner of Griffith Road and Clemensville Road? What you're looking at is a sewer treatment plant. On a hot August day at that intersection, it does not smell good. That is an example of economic obsolescence. There's nothing you can do about it. Nearby power plants, landfills, there's nothing you can do about it. So on that note, I'll leave you guys for the day. We are, yeah, go have lunch, right? So we are going to finish here today. So when we come back on Thursday, we're gonna do our sales comparison approach. So we'll do the math for that. Then we're gonna wrap up Unit 17. We're gonna quickly go through Unit 13. I project that you'll have 1 or 2 questions from 13. So that's one we're gonna flip through real quick. We're going to Kahoot on Thursday. So we're going to have our financing Kahoot, 14, 15, and 21. So you guys can get ready for that. Otherwise, I think we're all set for today. If you guys have any questions, don't hesitate to reach out to me and let me know. But we will see you guys at 9 a.m. sharp on Thursday. And we keep going.
Thank you, Julie.
Thank you, guys.
Thank you, Julie.
Thank you, Julie. Have a good day.
Thank you. Have a good one.
Thank you. Bye. Have a good day.